ESG has been making the headlines, but what does it actually mean? Well, the concept is simple. Make investment decisions based on corporate policies. So let's break it down for you. E stands for environmental, a company's initiatives to fight climate change and become more green. S is for social, how the company treats its employees and the community that it serves. And finally, G, governance, the company's leadership and decision-making. Now, the movement has become a big part of the investment landscape, attracting trillions of dollars in investment, but the doubters say it's become little more than virtue signaling. So can conscientious capitalism live on? Well, it's time for Yahoo Finance's debate. Over to Julie Hyman, Brad Smith, Rick Newman, and Jared Blickery. Hey, guys.
Hey, thanks, Rochelle. Appreciate it. So ESG, the reason that it has come up even more so recently is that there has been sort of a battle, if you will, between investment managers and, for that matter, some pension plans that want ESG to be part of their investment decisions, and then some states or other figures who do not. And Rick, you wrote about this week that Larry Fink of BlackRock, of course, basically said, I'm not saying ESG anymore.
And that's important because Larry Fink has been one of the biggest proponents of ESG investing, and BlackRock is huge. So if BlackRock is actually doing this, many other investment managers have to follow. Specifically, think about Ron DeSantis. I mean, he has declared what he calls this war on woke capitalism. That is pushback against ESG investing and other things that might be related to ESG investing. And the state of Florida has actually said some of their teacher funds or things like that, they actually do not want going to any investing firm that practices ESG investing. So that's the blowback. So what is Larry Fink talking about? I don't think we know. Is he just going to rebrand it? I mean, is it going to be the same philosophy? It kind of look for these virtuous companies, as you might call them, or is he actually going to change his focus? I don't think we know that yet, but that's what's at stake here.
Well, what he said in the past is that climate risk is investment risk, is portfolio risk, and he had correlated the two. So if we kind of separate the E side from the S side of ESG, where that's where you get into the more politicized annexation of woke, which has been co-opted and perhaps so muddled to the point where it is distant and deviant from the actual meaning of where companies were more values-based, where they were trying to be more conscious about the consumers that they were serving, and growing out a more global or even just more diverse client base as well, which investors should look at and say, hey, potentially that means growth for the business. Potentially that means expansion of the market. But instead, that's been pushed to a different direction.
Yeah, and you're looking at the money that we've seen in these things, right?
Exactly. And to your point here, the rise of ESG, I think 2019 was probably a breakout year. That's when we saw a lot of ESG outperformance as well. And so these investments, which had been considered fringe, suddenly they're outperforming the S&P 500 in 2019, even 2020, I believe. But then they took a back seat. And I'm going to show the Wi-Fi Interactive here. I have an ESG funds heat map, and so everything's equal weighted here because we're not dealing with market cap. But in the upper left, GSPC, that is the S&P 500. This is year to date. It's up over 15%. Very impressive. You'll notice that all these ESG funds, these are underperforming. Even the top one just underperforming by a little bit. This covers the USA. This is iShares. This is a ESG ETF for them. Now you take a look over the last year, you're going to see even more underperformance. You got some red there. And then 2 years, it's looking really bad because we go back 2 years ago, that was when a lot of stocks were topping. One of these down, XOSC, down 33%. And then 3 years, still, the S&P 500 comes out on top. So it's definitely been outperforming, and that has been diminishing some of the arguments pro ESG. Now, I have a couple of notes here I want to show on the Wi-Fi Interactive as well. This is from Sanford Bernstein. I'm going to highlight some text here on the Wi-Fi Interactive. The term ESG was first coined in 2005. Fast forward today, ESG investing is at a crossroads, and they highlight some of the political uncertainty that leads to it. And here's the key line. The term may change, but the concept of ESG has been around for over 200 years and has been reinvented multiple times. Now, I want to show another source here. This is from Goldman. Energy firms' focus has shifted from ESG to energy security, and we can see in this chart going back to 2010, the cyan line here, which has just risen meteorically here, and that comes with the timing of the conflict from Russia and Ukraine. That has shot up, and it has overtaken the concerns, the interest in ESG. So there's a switching of paths here. where the rubber met the road and people had to confront the reality that, yes, energy security is important. Now, can these two concepts be merged? Can we go back and maybe have a best of all worlds here? I would like to think so, but it's an evolving concept, I guess is my point here.
I think the evolution of the concept argues against the concept completely.
Really?
So I've followed the energy markets a lot during the last year. So and they are a target of so-called ESG investing, right? So defund fossil fuels and so on. Interesting concept. I mean, I certainly don't argue with the fact that we need to decrease the amount of carbon in the atmosphere and deal with global warming. But at what cost? Are we willing to have shortages of fossil fuels that we need right now? Actually, no. So gasoline prices hit $5 in part because energy firms don't want to invest in drilling anymore because their industry is under attack and they see what's happening. I mean, we're shifting over to renewables and even government policies now support that. So they don't want to invest in new capacity. They want to give money back to shareholders, and we end up with skyrocketing energy prices, and that undermines public support for the whole thing.
There is a new crop of investors, though, folks like at Engine Number One Capital.
Yes.
Who are pushing internally, not to defund energy, but to be shareholders of these companies and internally push for changes, push for increasing investment in renewables.
And they have 1 or 2 board seats at Exxon now,
yes.
right? And they're supported by the California Teachers Pension Fund, so that's where it's coming from.
So there are different ways that people have been pushing for this.
This highlights a problem. So some traditional energy firms are doing more for renewables than others. How do you fit that into your ESG portfolio? Do you say BP is in the ESG portfolio, but ExxonMobil is out? What's your threshold for green energy investment?
I think it depends on the portfolio. I mean, just to take a step back here, one of the other older terms for this is stakeholder capitalism, right? Is that when you're investing in a company, you shouldn't just be considering the bottom line and the return, to your point on that heat map that we get, that's not the only thing that you should consider. You should consider whether the company is a good corporate citizen, for lack of a better term. Is it helping to, promote environmental, social, and governance goals? And I think if that's how somebody wants to invest, that's a valid goal. If that is if that's how somebody wants to invest, recognizing that just the bottom line is not the only thing that you're assessing.
And the other part of this too is where for individual investors are they looking at companies that are not trying to make such a drastic shift, but are starting out with that as a North Star and saying, we're going to bring the rest of the industry with us, or at least putting pressure on the rest of the industry to make a change or to recognize that there's a clear clientele there. Take Tesla, for instance, a company that made somehow electric vehicles sexy by coming in at the top end of the kind of luxury model there and then saying, all right, now we're going to make this more approachable for everyone else. They've never moved off of their environmental vision or that goal, but they have brought a lot of other traditional combustion engine manufacturers along with them into that space because they are now realizing that they're going to miss out on that wave.
Also non-union.
Also non-union.
So how do you square that?
That's a good.
So I would like to introduce one other factor. So you said 2019, sort of the peak for ESG
right,
investing.
and also a peak in the growth stocks, critically because those were considered ESG stocks like Apple, Meta. Those were considered ESG just because they were not Exxon. So that gets back to the shifting definition of the very term.
Okay, so Donald Trump was president in 2019. The U.S. was doing basically nothing to address global warming and climate change. Joe Biden comes in. We now have the most aggressive U.S. effort to address global warming and climate change ever with the Inflation Reduction Act, all these incentives for green energy. If you care, I mean, these goals are important. I think we probably all agree all these goals of ESG investing are important. The question is, should you go after them through investing? And there are other ways to go after these goals. Activists do it through boycotting companies or calling attention to practices they don't like. We now have massive government intervention in the market with literally hundreds of billions of dollars of incentives for green energy. That is going to be way more effective than ESG investing portfolios. Absolutely.
Yeah, I mean, that's a really good point. And that's a good point that the inflection here now, a little bit away from ESG, comes at a time when the government stepping in and doing the job.
There was a perception before the Biden administration that was accurate that the government's not doing anything here. So let's see if we can muster some private sector incentives to do this.
There's one element of this that we haven't talked so much about, and that's the idea of so-called greenwashing, or whatever term you want to apply to it, which is that when we had the upsurge in interest in ESG and companies wanted to be thought of as ESG, they would put this language in their statements and on their conference calls. Were they really adhering to this? I mean, you bring up big cap tech, which also are incredible consumers of energy. You think about data centers and the energy that they use. That is a very energy inefficient business. So, you know, there's also that idea, and this kind of goes to your point as well, Rick, that it's really difficult to say this company is adhering to ESG or it's doing it in one area but not doing it in another area, and how do you weigh all of that?
And companies change.
But I mean, at the end of the day, for the amount of companies that are sensing where they can satisfy investors or satisfy the narrative that they've put forward to client bases by saying, well, here's a loophole that we could just buy into, for the amount of offsets that we can purchase instead of actually changing the operation, that's perhaps going to upset investors, because then it will upset what our margins actually look like.
Greenwashing is definitely a thing. It happens. I mean, as a reporter, I've tried to look into this. It's hard. And I can't imagine how any ordinary person who has a day job and just looks at his or her portfolio and tries to pick stocks here and there, you know, evenings and weekends, could ever figure this out. So yes, you can rely on investment managers to do that work for you. I don't really have a lot of trust that even the investment managers can keep up with it. There are just better ways to go after these goals. And you know, to go back to what I've been following a lot, which is the war on woke capitalism. This is we have a massive culture clash in the United States these days that is just going to continue, and CEOs are constantly having to figure out. This is mostly social issues, which is 1/3 of ESG. CEOs are constantly having to figure out where to take a stand on social issues, where not to take a stand. Of course, we saw this blow up with Bud Light. Trying to support the trans community and then getting pushback for that. The struggle is part of the process. The struggle, these battles between activists saying that companies should do this and the companies saying, we really don't want to get involved. This is normal. This is actually how cultures evolve, and it's part of the process. So it's messy.
Do you see it as cyclical, though? Because it seems like activism has been on the rise over the last few years, and maybe it's just a secular thing that changes with the generations, but it seems like all that activism has been increasing recently.
It certainly has been politicized. Right. For a lot of reasons we all know about: social media, cable news, the Trump effect. Everything gets politicized, and there are always controversies that companies get sucked into unaware, and they never thought they had to have a plan for. I mean, it used to be Delta gave discounts to NRA members, and they canceled that, and then they had a big fight with gun owners. There's always going to be an issue, and you know what? Consumers just want their brands, if to the extent they care about them, to be authentic. Right. They want you to just kind of evolve with the culture, and maybe when you have to step up and take the shot. A lot of CEOs don't want to take a stance on these issues, clearly.
Bud Light is a very good example of that.
Yeah.
And they're a good example because they wavered on it.
Yes.
And for companies that have shown that they're willing to be performative in Bud Light's case, and I'd use that specifically because it was pure performance, because they did not stand by what they were putting out in their messaging. That was a mistake. And it was a mistake. It's proven to be a mistake.
So that should have been part of the plan all along.
Right.
This is going to be controversial. We need to anticipate it. What's our response going to be if we get attacked for this?
Conservative critics of ESG argue the investing strategy prioritizes so-called liberal goals over investor returns. So is the backlash to ESG investing working? Companies are certainly quieter about their initiatives. Mentions of social impact moves during earnings calls, like sustainability and ESG, they fell off sharply in recent quarters. But our next guest says ESG investing isn't going away. It's just becoming quieter, and that's a good thing. Jeffrey Sonnenfeld is the Lester Crown Professor in the practice of management at the Yale School of Management. He joins me now. Jeffrey, great to have you here with us. We should probably contextualize and say that there have been a lot of pressing issues that companies have had to address in their earnings calls as of recent as well, whether that be trying to get into the conversations of generative AI or whether that be macroeconomic conditions. But where ESG continues to hold space at the table, what have you noticed within these calls and within those discussions and what they're conveying to the street?
Brad, I love your question so much. You're lucky we're separated remotely or I'd be hugging you. In fact, I could scream for joy. There's so much misinformation swirling about. And as you had to suffer through your prior panel, a great deal of misinformation circulating there. Of course, there's less discussion of ESG at earnings calls because they're earnings calls. You know, you don't see an AI technology conference going through the bits and bytes of earnings at an AI conference. You don't see people going off to a healthcare conference talking about the quality of work life of their workers, talking about earnings. As people realize, an earnings call is supposed to be about earnings. You don't see product launches talking about earnings. That's why you see very little discussion about product launch on an earnings call. So it's that people are realizing that's supposed to be a finance call, and that's how they're directing their attention. If you take a look, there was an article by a guy named Chip Cutter, a good friend of mine, in the Wall Street Journal. I just took him to task for it. It's not his fault, but his editors rewrote his article to put a false headline on the Wall Street Journal. Yes, you heard it here first. You look that up, type up Chip Cutter. Every single example he has in there is how companies continue to focus on ESG. They're trying different ways to try to figure out what their priorities are. No company tries to do everything on this huge scale of injustice in the world, what's most relevant to their constituency. But the headline says companies are retreating, but then there's not a single example of a company retreating, in fact, of ESG. You take a look at the companies that have been targeted, they are soaring, they're outperforming. Sure, Kohl's and Target and AB InBev have had some issues and maybe attacked by the anti-wokester jokesters out there, but so have, we have issues in Home Depot, another retailer, or Chick-fil-A has been attacked. It has nothing to do with woke issues. It's absurd, but the companies that have been attacked, JP Morgan's up 15%. American Airlines been attacked. They're up 60%. Delta's up 60% since they've been attacked in the year. Apple, as we've just talked now, it's just crossed to the 3 trillion mark. It's doubled since they've been attacked. Microsoft is up 60% since they've been attacked by the anti-wokester jokesters. Salesforce is up 60%. It is false information. Is the anti-woke campaign has gone nowhere, except it's costing taxpayers. Research done on Texas, it's costing them close to $4 billion in the next couple of years because they're cutting out options to invest in some of these funds like BlackRock. So it's actually costing taxpayers, shareholders, and in fact not being helped. They benefit from it. And we've actually done research on the Russian retreat, the 1,400 companies, that major multinationals in Russia. The more dramatically and the earlier they pulled out, the better their stocks performed. Doing good is not antithetical to doing well.
There's a few topics that you brought up within that answer and want to dive into a few of them. And first, I guess the one that comes to mind as you were running through where this is costing taxpayers even, taxpayers have shifted around a little bit more, and so the makeup of states looks vastly different than it did before. The economies of those states have changed in their makeup and their fabric because you've got perhaps some more wealthier now tenants or residents of that state that have migrated. All that to say, there's been an argument about some states now in some what would be called anti-woke areas that are doing better than other states that are in more conscious, more perhaps even diverse areas as well, and using that as an argument that they are doing worse than states where there is not any wokeism allowed. And so I just wonder how you think about, how you parse through, how you look through the data when clearly there's a much larger shift that's actually been taking place, and it's not just one thing.
Well, I mean, you take a look at where the transfer dollars have gone. It's the if you're talking about a red state, blue state issue explicitly, it's the blue states that have been bailing out the red states and continue to. The red states are getting about 78 to 80 cents back on the tax dollars. The blue states, they put in what you're considering the more woke states and the tax dollars. The red states, or you're considering the more anti-woke states, are getting $1.50 to almost $2 back on the money they put into their taxes. Why? Because they're the states that have walk-away, no-fault mortgages. We don't have these no-fault mortgages. So when people go into financial collapse, it's the Northeast and California that's bailing out the South Center and Southwest. The tornadoes, hurricanes, these natural disasters, they're overwhelmingly money that's going into disaster relief in these places. So we're actually getting a worse return for the tax dollar from blue states and then transfer to red states. And military spending has overwhelmingly been cut back $3 to $1 in terms of the blue states suffering as we've transferred, and the ripple effect of that into red states. So there's a weird byproduct there. But take a look at company by company going there. Coca-Cola is doing very well. Delta, these are companies which are in the supposed red states that you have that have taken strong positions. Dell and American Airlines, they take a look at what they think is the proper position for their company, for their brand, whether or not it's on women's reproductive rights or on voting rights access or whatever the issue is, pulling out of Russia. They take a position they think is appropriate for their constituency. They look at 100 issues, each of these companies, and they come up with a decision. And guess what? They're outperforming companies in their industry for having shown that character pays off. This is not a new issue. It's George Weyerhaeuser told me in 1977, a staunch Republican, that we have a license to operate from society at Weyerhaeuser. We violate the terms of that license, it can be revoked. Jim Burke, Johnson & Johnson, told me in 1985 that a corporate character is its most valuable resource. And that's what really matters is we're looking at social capital here, and it's way more valuable than financial capital.
Curating social strategy for a brand is a delicate dance. Take the timely example of Bud Light. A campaign with trans influencer Dylan Mulvaney sparked a wave of hate. Subsequent boycotts saw Bud Light's sales slip. Suddenly, beer became politicized. Some were furious Bud Light partnered with Mulvaney. Others say the brand didn't do enough to support her. When catering to one group angers another, it can feel like damned if you do, damned if you don't. Gretel Going is the founder of Channel V Media, a communications company and strategy and PR firm here in New York City. She joins me now. Thank you so much for taking the time.
Nice to be here. Thank you.
Absolutely. So let's dive right in. Dylan actually recently released a video on Thursday and speaking for the first time about the Bud Light incident. Let's just roll this clip really quick and we'll start things off there.
For a company to hire a trans person and then not publicly stand by them is worse, in my opinion, than not hiring a trans person at all, because it gives customers permission to be as transphobic and hateful as they want, to turn a blind eye and pretend everything is okay. It just isn't an option right now.
And so there's been a lot of back and forth about what Bud Light did wrong within this, but from a communications perspective, what should they have done?
Well, in this situation, I mean, her point is fair enough. They might not have been contractually obligated to stand by her no matter what happens, but I think that there is an unspoken and unwritten contract when you work with influencers that, hey, this brand has done their homework, they know what they're getting behind, and they are going to stand by me no matter what the backlash is. I mean, you would assume that this brand has made an informed decision about who they are and what they stand for, and that I am part of that. So in this case, I do think that they should have stood behind her. I also think that there's probably a disconnect between marketing and the rest of the organization. I think we have a case here where we have like some pretty daring and bold marketers who kind of see the way the tides are turning, but their company wasn't necessarily aligned with them. So that's where we're seeing this disconnect out there in terms of how they're communicating.
So for some companies, they purely look at this as a way to broaden out the customer base, engage with a new type of potential beer drinker that they may not have seen gravitate towards them before. But with the decisions that they made, it became clear that it was purely performative in the messaging that they were putting forward before and the backtracking that they did thereafter. So even after all that has taken place, now what? Because there's a new campaign that's come out that focuses more on the distributors, the people who create the beer, the people that are behind the operation as well.
Yeah. I don't know if it was performative. I do think that Bud Light has a lot of really strong values, and it does want to, I know their mission is to bring people around the table to have beer, and I do think they want to be more inclusive, but I think that there's such a stark contrast between their kind of traditional brand and this more progressive way that they were going, and I think they almost potentially did it too quickly. And people weren't ready for it. And I think actually this campaign that they're coming out with that you mentioned, that would have been a nice stepping stone to show like, hey, here's how diverse we are, here's how inclusive we are, and then suddenly start broadening the definition of what inclusive means to them. I think they kind of went 0 to 60 with this, which I'm all for, but I don't think that their audience or even their management and their leadership was ready for that.
In a world of misinformation, disinformation, corruption, and vested interest, data is one of the greatest assets we have. It is, in theory, unimpeachable. It tells a story free of bias, opinion, or motive. It simply is. But in the world of economic and monetary policy, it's still king. Policymakers rely on it in its totality to make decisions that impact all of us. For the Federal Reserve, the credo has long been that policy is never on a preset course. It adapts to changing information. Now, the jobs report and its headline number has cemented itself as the statistic that stands out from the crowd, summarizing the health of the world's biggest economy at a glance. Now, it's not meant to be a magic number, but it certainly has an outsized importance in shaping sentiment and changing decision-making as well. But not all jobs are created equally. What kind of employment are we creating? What is the true rate of unemployment? Does any of this actually matter? Well, if the jobs report is just a blunt instrument guiding monetary policy, is it useless? Well, joining us now for the discussion, Yahoo Finance's Julie Hyman, Miles Udland, Shauna Smith, and our very own Josh Schaefer. Julie, over to you.
Thanks so much, Rochelle. We're feeling very existential here, apparently, at Yahoo Finance. Why are any of us here? Why are we even talking about the jobs report? And that's what we want to discuss. And I sort of have been thinking about this in two ways. One, is the jobs report accurate, for lack of a better word? Does it actually give us a picture of what's going on in the job market? And secondly, is it even the right number for the Fed and the market to be zeroing in on? And so to sort of take the accuracy question first, just one thing that I've been thinking about is the revision to the job report, which we get every month, right? We get the payrolls number every month. It has now beaten expectations for 14 straight months, which tells you something about the ability of economists to forecast this thing. But every month it gets revised, and the amount by which it gets revised varies pretty widely. We've seen it get revised lower as of late, but again, that's very volatile. And I was even looking back at previous years and the sort of average revisions that we see on an annual basis, which again, monthly wise are really divergent. But overall, we have seen bigger revisions in more recent years than we had seen sort of pre-pandemic. So that's just taking sort of the accuracy piece of it. But there are a lot of different components of it. Shauna, you're looking at what I think.
There are so many different components of it. And I think this report in particular is so hard to kind of figure out just in terms of how the Fed is looking at it, what it could mean for policy here going forward. You mentioned that headline number, a massive beat once again, the 14th, like you said, in a row. But when it comes to unemployment, that did tick higher, up to 3.7%. So I was taking a look at labor force participation, more specifically what we're seeing in prime age workers. So that's the workers between 25 and 54 years of age. And that ticked higher, went from 83.3% to 83.4%. And I bring that up just because that might be one of the explanations in terms of why we did see the unemployment rate tick higher, while we did get that blowout beat on the top line number on that massive more than 300,000 jobs created last month. So certainly more people entering the workforce, but maybe they haven't found that job yet. So that's why we did see that unemployment number tick higher. But I think that this is almost a head scratcher in terms of what exactly this means for the Fed, how the Fed should even be looking at this data, because like you said, Julie, so often we've seen a number of revisions and they're pretty significant when you take a look at some of those trends. So I think there's still a lot of debate about whether or not we should see a pause, and then of course, if we'll see another rate hike in July.
Well, I was going to steal your point about prime age participation, but we'll let that one lie. 83.4%, highest we've seen since 2007. Julie, you know what I'm going to say about the accuracy of it, and my question is going to be: do you have any better ideas for other data that we would gather?
In fact, actually, to that point, so last night I was at an event and I was sitting next to the head of Homebase, which is a company that provides software that basically does employee management, particularly for hourly workers. So instead of like punching a time card, you would use this software. And he said to me, he thinks that the way the government measures this is quite outdated. And I said to him, do you have it? So what are you looking at then? And he pointed out data from the likes of Indeed and ZipRecruiter as being a better way to gauge what's going on. And he said even more, look at those companies, see what they're doing with their own employees. Are they laying people off, as ZipRecruiter has been doing? So that also, I don't know if that's a better idea, but that's just a better idea that someone gave me.
So I think the reason why we care about any jobs report is ultimately because it is going to most likely determine what the Fed is most likely going to do next, and that's really all the market cares about. If we look at the market today, it is suggestive of a Fed that's likely to pause next month. I mean, look at the leaders in the market right now, regional banks, kind of the Dow has been beaten down, it's been a laggard, and the Dow is outperforming today, so that kind of tells you what investors think, and I think we all know I'm an absolutist about like, the market is right, and then we will figure out why they're right about what they're saying. So that's kind of my view on it, and I think, looking at the labor market in general though, and trying to make sense of this report, I mean, I don't actually think it's that complicated. I think the reason economists keep getting the jobs number wrong, they're always wrong, but the reason they're wrong on the low side is because people have been waiting for the economy to roll over for months and months and months, and today's jobs report shows it's still not happening.
Well, and the word slowdown should probably stop being used, right, as far as overall slowing down the job growth. I mean, it's the biggest number we've seen since January. You strip out January, it's the biggest number we've seen since August, right, as far as monthly growth goes. So that was something interesting just today as I was looking at different commentary. I think people are starting to change that narrative a little bit. But overall, I think a lot of people said you can take from this report what you want, right? You can make a lot out of the unemployment rate. You can make a lot out of wages coming down on a monthly rate compared to what they were last month. And you can then say, well, the Fed's getting a little bit of a win here. We're starting to see a slowdown. Or you can just look at the headline number and say, well, the economy is booming. The Fed should hike again. And it seems like a lot of people that were in that camp before today are still in. It didn't change camps. It seems like everyone's still in their camp that they were in yesterday. And that's sort of where we're sitting.
Yeah, but whether or not that's validated, I think, is the other big issue here. Because, Miles, like you're saying, that this is the jobs report is what the Fed does look at. But I actually question that, whether or not there's more emphasis on CPI now, the next inflation print that we are going to get right before that meeting, whether or not that matters more, given the fact that this report, you can take what you want from it, to Josh's point, just in terms if you want to look at that rising unemployment number or if you want to look at that massive headline beat.
Well, I think for the last 15 months, it has been true that inflation data is more important. And I think it still is more important because, we saw the move in Fed fund futures last week when when PCE number came across. That was, firmer than expected. I think 4.6% increase in core PCE over last year. So still more than double the Fed's 2% target on their preferred measure. Some Fed speak this week kind of bumped it back, and we haven't seen a huge move in market expectations for the Fed based on jobs. So yes, I think inflation became the new jobs report, but ultimately, I think that the jobs report is where you get, let's say, the simplest read on the economy's health, because inflation is measuring a specific set of inputs and what you're paying for them, but how much people work and what they make while they work is most likely to have the largest impact on the overall story for the economy.
Well, and guess what? What they're making is not going up. It's not meeting inflation, right? And it's sort of stagnating if you look at those average hourly earnings. What I think, and this is, I guess, sort of, I'm channeling Miles to some degree here, is...
Look at this. Look at this.
Like, you could argue it's a lagging indicator, which most economists say it is a lagging indicator, and you can sort of quibble about what it actually tells us. But there are two data points to me that are the easiest to relate to emotionally. One is the jobs report. Do I have a job or not? Does the person who lives next to me have a job or not? And secondly, am I paying more for stuff? CPI and jobs. Emotionally, those are the ones that resonate the most with us in our everyday lives. You can talk about PMIs. You can talk about, all of these
Easy
other...
on the PMIs.
Well, but that's what I'm saying.
I love the PMIs.
But they don't have that same sort of intuitive, relatable understanding that jobs and CPI do. Right?
To you. No, I agree.
To me.
To my people like to talk about the unemployment rate.
No, I agree.
People like to talk about.
Yeah, I think this is the reason why jobs matter, because you can, think about it in this framework, to use like the media example. If you're doing NBC Nightly News, can you put this in the A block? The answer is yes. You can't put PMI you shouldn't put PMI in the show ever in any circumstance. But you can say, the labor market says X, and you don't have to know anything about the economy to understand what the market, or not the market, what the report is trying to tell you.
Yeah, exactly. And I also think we haven't even just talked about the number of job openings that are still out there. That was over 10 million, the most recent report out there. So this whole supply-demand imbalance. So people out there, even if you're surveying who has a job, who doesn't have a job, I think the overarching, question that still remains is what exactly is going to happen with that supply-demand imbalance. We still have labor shortages when you take a look at some specific sectors, construction being one of those, leisure and hospitality, where we did see some gains this past month here, but certainly we're over 300,000 jobs shy of where we were in hospitality before the pandemic.
I think overall, though, if we want to talk about data, we could talk about how many of those jobs are repeat postings or how long have they been up too, right? When we talk about over 10 million job openings, how many of those jobs are actually open and are actually looking to get filled? We're never going to have that answer, but I think that's probably the problem with part of that data too.
Yeah, I'd be more interested in having that conversation. about is the JOLTS report as good as we want it to be versus like is the BLS.
Have another idea.
That's it.
That's it.
No, because it's tabulating open jobs at the end of the month, but it's like how do you qualify what is open, what's not? And I think your home bases, your Indeeds, your ZipRecruiters would have a lot of ideas in that direction of how many listings are ghost listings, how many listings are you actively trying to fill? What's the difference between actively trying to fill a job and a job just hasn't come through because you can't find the right candidates?
Well, and I think something that we've been sort of talking around too, to your point, Shauna, is what does all of this tell us about what's going to happen? Mm-hmm. And I don't know that it does, right? What kind of predictive ability does all of this have? It gives us a temperature on what's happening right now, looks backward a little bit, but if you have a job now, are you going to have a job 6 months from now? I don't know. I don't think we have the answer. I don't know what data.
I think everyone would like that crystal ball, right?
Yeah. So I think that's the thing to me, though. It's like to criticize any piece of economic data on the basis of it being backward looking. It's like literally everything's backward looking. No one can see the future. There is. You want to go into it. There's no future. Like if you break it down to that level,
the future is AI takes all of our jobs.
There's also no past,
then we
right?
don't talk about
all we have is now and infinite nows and all this kind of stuff. And so basically, though, like the market is, and this is why I like markets, because markets are trying to guess at the future, and they give you information if you watch them closely about what an aggregation of investors believes the future will be. Today's reaction to the jobs report suggests investors think that in the future, the economy will kind of chart the course that is slightly better than it's been, but not so much that we need to see a material change in how the Fed thinks about rates.
brunch reservations to get in New York City. Ron, thank you so much for joining us today. You've been in business for 33 years. From a labor perspective, what's the secret to attracting that talent, both the wait staff as well as your cooks?
Well, you know, a lot of people who have work at Bubby's have been here for 20 years or more than that. Some people have started when they were like 14 and they're 40 now. So one of the things is just that we have a real community. We pay a lot more than most restaurants do, and well, when Bubby's is successful, my entire crew is successful.
You said you pay more than most restaurants. So what sort of incentives are you offering employees? And really, what do they want right now?
Well, what they want right now is to be paid well and to have a personal life respected, so that there's a, you know, so that it really is not, I think there's a certain amount of freedom of having a personal life that may not have been thought about before the pandemic, and I would say there's more flexibility right now and more sort of liberty in our crew.
So you have hourly wages, and then on top of that is the tipping.
We have some of our crew gets tipped, the front of the house gets tipped, and the back of the house doesn't get tipped.
Got it. And in terms of tipping, we're dealing with inflation, a lot of high prices right now. Are you seeing consumer behavior shifting on the amount that they're willing to tip servers?
I have not seen anything like that, but I haven't heard anything like that here. So it seems like everybody's happy at Bubby's.
And you brought up the pandemic. We're in this post-pandemic world now. How are you able to weather that storm from a labor perspective and really keep the doors open during that time?
Well, we really were flexible and had a lot of enthusiasm to do whatever we could. And as soon as we could open outdoors, we did. I grew up in Utah in the mountains, so I'm sort of used to thinking about eating outside in weird weather. And so we really were able to lean into all the opportunities as they happened without sort of wondering if it was Armageddon or a pandemic.
I admit I was one of those people that weathered the storm quite literally in order to eat outside. And when we talk about inflation and price increases, have you had to raise menu prices and pass on some of that cost to the consumer?
We have had to do it, and we've been very judicious about it. We're really making sure to just sort of cover our expenses rather than turning our price point into something else. Because, Bubby's has a certain sort of middle point where we fit in, and I don't want to start getting into the overly expensive category.
And where have you seen the biggest price increases? We've seen certain ingredients like eggs skyrocket, and as a place,
chocolate, coffee, meat, all kinds of things, just inching their way up for all kinds of reasons.
So how do you battle those inflationary pressures?
We really just keep a close eye on our costs, and we adjust when we need to. We don't hesitate to do it if we need to. And, so far it's worked out, and I would say that in the end result, our check average is up maybe 5% from what it was, or 6%.
And are you seeing consumers change the way they order, maybe ordering less, sharing more?
Well, no, I think that people who are coming to Bubby's seem to be having the same experience as they were before, or more so in a way.
Okay. And then in terms of, in dining versus delivery, because during the pandemic, delivery really became a popular option. Are you seeing those levels revert to pre-pandemic times? Are you still seeing delivery a very popular option right now?
Well, what we saw really was that our delivery business went up by about 500% and stayed there. So it really is a completely new revenue center for us in a meaningful way, the delivery business.
And is in dining back to pre-pandemic levels?
We're up probably about 40% from the pandemic.
Now, I know you have a new cookbook. You're re-releasing this.
Yes.
All about pies.
It's all about pie, pastry, seasonality.
Okay, I'm someone that really can't cook a pie. So what is the secret to being able to create something like this?
Well, one thing is that this is sort of the pinnacle, but there's ways to make, for example, a cookie crust pie that's so easy with graham crackers, and there's homemade graham cracker recipe if you want to do that, or you can buy commercial ones. And so there's all kinds of levels of pie to make in there, and it's really worth learning how to do a flaky pastry crust, even though it takes a long time to be able to do it.
It's a labor of love, right?
It takes years and years to really understand it, because you have to go through all the seasons. It changes all the time, and it really is a learning process.
Turning now to inflation data for the month of May. The headline number showing a slowdown, the core figure coming in at 0.4%. The data showing that while inflation might be slowing, it is still not enough. That number, which excludes food and energy, is the one that the Fed tends to focus on. We had a chance to speak with Rakeem Mahbood, who is the Groundwork Collaborative Chief Economist, Managing Director of Policy Research, and Teresa Ghilarducci, who is the Professor of Economics and Policy Analysis at the New School, plus Danielle Twiss, an MA candidate from the New School. Earlier this month, we had this talk about the data. So we've got the numbers here on the desk with us, and starting to really dive further into some of the details here. Rakeem, would just love to get your take off of some of the headline figures that we've seen thus far, and perhaps some of those pockets that really stick out from this report.
Yeah, I mean, to me, what sticks out in this report is the fact that, inflation is sticking around, and whatever the Fed is doing is not working. Mm-hmm. And the reason it's not working is because the tools that the Fed has to address high prices don't actually get at the core root causes of what's causing today's inflation. We have corporate profiteering, we have supply chain issues, we have geopolitical factors, and some of these issues have started to moderate. I mean, supply chains have started to ease, but the fact of the matter is the Fed, through its 10 consecutive interest rate hikes, and we'll see what they do tomorrow, have simply been hammering away at the labor market and really trying to weaken a labor market that has been remarkably strong coming out of the pandemic. And so I think we really need to take a different approach, and the Fed not only should pause tomorrow, but really pause going forward and see these 10 rate hikes play out.
Teresa, what do you think here? I mean, the Fed's traditional method of tamping down inflation is trying to tamp down demand. Is that part working?
Well, I completely agree with you and with Rakeem. They're really operating on these very old theories, and also the present day fact that they're given some authority in a place where they don't have any tools or effectiveness. So they're given this huge hammer of interest rates. Interest rates for mortgages, depending upon the way you look at it, is the highest it's been in in a couple of decades. So they're hammering the housing market, but the theory says to hammer workers, hammer workers, hammer workers. This old idea that workers are pushing up wages, and then passively the companies just have to push up prices because what's a company to do? When in fact that's not happening. Last year, workers' wages was tight and did go up. We did see some nominal wage increases, but only 4.3%. Whereas prices went past that 4.7, 4.9, and we see it today. So workers are actually helping keep down prices because their productivity and their wages are helping companies be productive. So we're asking the Fed to do too much. They've gone too far. They've actually created some crisis in the banking sector. That was something their risk management officers should have figured out. What is a sudden rate hike going to do the balance sheet of Silicon Valley Bank? So for sure, tomorrow they should pause, and we should look at other sectors of our regulatory system that could help consumers and everyday people, like Danielle.
Well, and Danielle, even within this, even as we think about some of those wages and how that's been factored into prices, I mean, it's important for us to remember, too, that wages are still well above where, at least in the growth, as that's starting to come down in wage growth, we're still seeing wages that are above some of the averages pre-pandemic times. And so with that, the prices, as businesses would say, they're going to continue to remain elevated as long as they can pass that through in a demand environment like this.
So I think the key thing is that prices are increasing at a rate that's higher than wages are. Mm-hmm. And wages started a couple years ago at a floor that was already too low for workers to afford their basic necessities in cities like this. And so when food and shelter, which is what workers are primarily spending their money on, are increasing at 6.6, 6.7%, and wages are seeing an increase of only 4.3, that's a real wage decrease. And so for working people, this is actually a decrease in their standard of living and a huge increase in their cost of living.
And I think people understand that sort of instinctively, even if they don't understand, right? They know that they know what's happening in their checking account, right? If they have a checking account, right? They know that they're getting squeezed when they're going to the grocery store, et cetera. We have seen something of an increase in worker negotiating power over this period of time. For the first time in a long time, we've heard a lot more union talk, for example. We've got the writer's strike, for example, going on right now. How long does that continue, Rakeen? How, if indeed the labor market weakens, do workers retain any of that power?
No, I think that is such a critical question. And just to double click on something that my colleagues have said, wages going up is a really good thing, right? People having more money in their pockets is a good thing for our economy. We all make the economy go. We should have more money. We keep the economy running. And we have seen over the course of the last couple of years, tight labor markets really bringing more and more workers into the economy. We saw 2 months ago, black unemployment drop below 5%, which has never happened in the data before. That is a remarkable achievement coming out of a pandemic. We have seen disabled workers, other marginalized workers really starting to see the benefits of a tight labor market. And with that comes an increase in power and agency and people able to demand what they deserve on the job, which is a good quality job, good wages. Look, the Fed is on a mission to destroy all that. That is the truth of the matter, right? They have put in 10 rate hikes into the system.
Well, but okay, to play the devil's advocate a little bit, to destroy all that, I mean, inflation is not helpful for people either. Non-wage inflation is not helpful for people either. And the Fed's mandate is to bring down inflation. So, wage inflation doesn't exist in a vacuum. You can say what you will about companies maybe taking margin, which is what publicly traded companies do. It's their mandate to do that to some degree as well. But, you can't, can you divorce, I guess the question is, can you divorce wage inflation from other types of inflation?
Yeah, no, you can't. But the Fed has to understand that wages and workers are not pushing up inflation, and they're smart, and I think they do, but they only have the one tool, which is interest rates. They're really hammering the housing market, and that's why today and last month we saw shelter prices increase so much. So they could take a pause to take a break on what they're doing to the housing market. I wish that tight labor markets were the only thing that workers needed to have some power. Yes, that brings in added workers, but for unions to get a wage increase that exceeds or even matches inflation, we're not going to see that anytime soon. The anti-union laws, are really hurting unions that might form in the new Inflation Reduction Act, the microchip companies, is mainly being built in the South. The big Taiwanese companies coming to Arizona, they're not organizing anytime soon.
In this week-long series, Yahoo Finance spoke to experts across the industry, exploring topics like real estate trends, the most affordable places to live, and planning for home ownership. For the latest news and updates on the housing market, renovation, real estate investing, first-time home buying, rental inflation, mortgage rates, and more. Take a listen.
We've seen a slowdown in market activity in general with buyers, but we've also seen most sellers don't want to sell their house. So buyers out there just don't have much to choose from. So the supply has not increased much, which means the prices haven't dropped too much.
And then I want to jump in here and bring the rest of you all in here and see what the trends that you're seeing in the rest of your regions. Let's go out west for this one. Kathy?
Hi. So, yeah, I would like to echo that. Our market has definitely slowed down. we were at such a hot fever pitch last year, and as everybody knows, the fever is not good. So I just feel like we're slow and steady now. I feel like we have a more stable market, more sustainable market. I actually think it's better for buyers than it was last year, even though the interest rates are higher, because number one, you're not paying over asking. We're getting some seller concessions, and interest rates are high, but there's workarounds on that as well.
Dan, what are you seeing in the Midwest?
Very similar. It's still a seller's market. It's still a competitive market, but it is certainly a different ball game than it was 12 to 18 months ago. It's been quite the ride as we were seeing those skyrocketing rates last year and a lot of uncertainty of what was going to happen. Are we going to see 10% interest rates? But now, interest rates have somewhat semi-normalized, where now buyers are looking in that 6.5, upper 6 range, where they've kind of accepted, unfortunately, this is the new norm, but the expectation is that rates are going to hopefully come back down in the next 12 months and they can ultimately refinance. So there was a lot of uncertainty. The second half of last year definitely slowed down. We didn't see any kind of big dip or anything like that, but we certainly saw a plateau and a reduction of buyer activity. But so far, the spring and summer market has picked back up. We're starting to see some more historical trends as things have happened pre-COVID crazy market.
Dan, what about that buyer activity? Are buyers being more pickier in this environment?
Absolutely. They actually have a chance to think about buying a house before they have to jump in against 40 other offers. So like she was saying, it's ultimately a healthier market. Of course, now sellers are saying, well, wait a second, where are all these offers and where's the waived inspections and waived appraisals? But at the end of the day, it is a much healthier market. Things are slower. Average days on market here are actually close to 80 days, which is a very high number compared to the last several years, but I've been in the business almost a decade, and certainly that's not an uncommon number. So buyers are a little bit choosier, a little bit pickier. They have some time really thinking about, okay, if this is a big investment, interest rates are higher compared to what they were. Is this really what I want? So at the end of the day, I think it's in a good spot.
And I want to quickly get to you, Melanie and Kathy. In your regions, is it a buyer's or a seller's market or none of the above?
I would say in Tampa, it's none of the above. So in Tampa, what we're seeing is we still only have about 2 months of inventory. And one of our biggest problems is quality of inventory. So if you have a house that goes on the market in Tampa that's really well prepared, then that house typically will have a lot of offers, maybe not as much as we did last year. You might have went from 10 offers to 2 offers, but we're still seeing multiple offer situations here in the Tampa Bay area. Florida is still really a desirable place for people to relocate to. We are just seeing houses stay on the market longer, but those houses that are staying on the market tend to be the ones that are in worse condition and need a lot of help and construction, and buyers just don't want to deal with that on top of having to pay, historically high prices and higher interest rates.
Kathy?
So, yeah, despite what you see on TV shows, it's not all designer clothes, glamour shots, and fancy cars that's happening in our market right now. So basically, so our average days on market is about 34 days. So it still is a seller's market in our region. At that 34 days, it wouldn't hit to a buyer's market until we're over 90 days. So we are still in the seller's market, but it actually is working well for both buyers and sellers because, as you previously mentioned, buyers do have a chance to actually look and they don't have to make a decision in 10 minutes for the house that they want to buy. Another thing that I have noted, and this was put out by NAR, that 65% of those that purchased during the pandemic have some sort of buyer's remorse. And I think that is because they had to make their decisions so quickly. And, they really wish they would have gotten, the 3rd bathroom or the 4th bedroom or in a better neighborhood. And so for those buyers, some of them feel like they are stuck because of the interest rates they got. But there are definitely ways that we can work around that. I'm starting to see a trend in lenders offering permanent interest buy downs. So instead of just the 2-1 buy down, we're starting to see a trend in permanent buy downs. Just last couple of weeks ago, I had a buyer that had a builder that actually brought her rate down 2 interest points. So it was 6.5 and it was brought down to 4.5%. And so because these are permanent buy downs, this really allows them to qualify for more house. So like I said, there's ways around trying to get around the interest rates and what's happening in the market, but I definitely feel it's kind of even kill for both buyer and seller, but still leaning more towards the seller's favor.
Dan, for those who are looking to buy in the Indianapolis area, what do they need to know? What's the 1, 2, 3 tips that you would share with them?
Again, it's always about being prepared. If you're a buyer and you're coming in there not having spoken to a mortgage lender about getting pre-approved, if you don't know what you really want, at the end of the day, you're going to waste your time, right? So it's always one of those as a buyer, have your stuff in order, talk to a mortgage lender, talk with a professional realtor, figure out what you're looking for. Because, I said that days on market are up. However, there are still zones that are very competitive. Hamilton County is on the north of the Indianapolis area, and it's, kind of the affluent suburb. And we are absolutely still looking at multiple offer scenarios. And, an interesting statistic here is that in Hamilton County, there have been more sales over $1 million than under $200,000, right? So in this market for Denver, that might seem crazy that we can even think of under $200,000. But here, the average price point, the median sales price in greater Indianapolis is $280,000. So, we have some areas that are still selling very quickly. Even the high-end homes, at least what we would consider high-end for this market, are selling in a short period of time. So again, to the comments of the nicer homes, still, very, very quick at selling. But if you're a buyer, make sure that you know kind of what you're doing. If you get in there, you may or may not have time to get a pre-approval letter, depending on what the house is doing, if there are multiple offers. So that's the biggest thing that I can recommend is talk to a professional, both a mortgage lender and a realtor, to kind of understand what you're looking at.
I'm joined with Joey Kaleli, Managing Director of Van Barton. Thank you so much for joining us. Your team has been really hard at work, and so what are you looking forward to with this conversion project?
The most is just creating a vibrant environment for new residents, new housing supply for the city, and really reshaping the face of Water Street.
For this specific project in the financial district, what has been the biggest challenge?
Just taking an office building, creating with all the complexities that go into that, and creating residences that people will love and are marketable, and that you come into and you don't realize that you're actually walking into a former office building.
Conversions can also become complex at times. So what has been, would you say, the misconceptions when it comes to converting office space to residential housing?
Yeah, I think a lot of people think that it's too complex, too costly, but it really is just creating a new building from an office building and making it so that people don't realize they're coming into an office building. Like I just mentioned, how you want to come into a space and feel like you're home and not that you're coming through a former office building. Those are the biggest complexities.
And so New York State leaders, the lawmakers, they're falling pretty short on these proposed tax benefits, those breaks.
Yep.
What is your response to that?
I think, simply put, the inaction of lawmakers is causing and exacerbating the issue with the rising rents. And so the inability to at least look at rezoning and enact something that would help more office buildings to be able to be converted, or industrial sites, or even changing the date, where south of Murray Street in Lower Manhattan, 1977, in certain zoning districts you can convert. But in Midtown, that's 1961. So a couple of those simple matters, they could change and really help put more units on the market, which will help that supply. It won't solve the whole issue, but it'll help.
And are financial incentives the way to kickstart a project like this?
I think it's a combination, the financial, certainly, but just at least looking at the date and changing the date of when an office building could be converted will go a lot further.
And for someone who's interested in this space and renting out an apartment or leasing out, how soon can someone jump on that?
Yeah, the team is hard at work, as you can see, and we're finishing up so that we have our first residents move in later in September of this year and early October.
It looks like the luxury market was off to a strong start to the year. Where does it stand today?
Well, I can tell you about California as I'm sitting in my car out front of a listing because I got a big showing, which is always a good sign. We are at about 20% down compared to last year of May 2022. In LA County, there was about 4,200 sales total up to this point. This year at about 3,200, so we're 20% down with that. But I will tell you, the biggest question, of course, was the ULA measure that was passed. Good news is that even though we had an extremely slow April, May has doubled and June is looking like it's going to double that. In April of this year, properties over 5 million in the ULA measure areas, which is that new tax that was passed, there was only about 10 sales that month, which was extremely slow. And then the next month afterwards, we had about 20, and it looks like we're going to have about 30 sales now in the ULA areas. So listen, we're all super hopeful about it. That's what I can say here over in Los Angeles.
So we've definitely seen some of that pressure here on the East Coast as well. Josh, Diane here right now. So you're seeing that dramatic impact to luxury real estate on whether you're talking about California, New York. Speaking specifically to California, what is happening to pricing as a result of this drop in demand for luxury real estate?
Well, look, I mean, of course, across the board, the buyer mentality is all about a deal these days. But with everything continuing to move, which is good, believe it or not, May was our strongest month with closings. So that actually shows that our next very strong month is probably going to be somewhere around July, because if you look at the most openings, which were in March, it's all kind of in line here 2 months afterwards. So that's all good stuff as well. As far as the inventory, yeah, we have a good amount of inventory. Good houses still are selling. There's good competition in the lower price points, which in LA, of course, are that $1 million, $2 million range. Things are still moving in that very strong. So look, even though, of course, there's a lot of not great stuff being told about California, LA real estate, I'm feeling pretty good about now considering.
Josh, who has the upper hand then at this point? Is it the buyer or is it the seller? Seems like it's tough to figure out.
Yeah, that's a good question. I like to be really cash heavy right now for the next 24 months. I think the buyer has the upper hand, although I can tell you in any market anywhere, especially with what I deal with, which is the ultra high net worth individuals in the high end market, you build a great house, you build a trophy, there's always somebody willing to pay for it. So we'll have to see what happens.
So, Josh, speaking of that, you building a great house, and you talked about inventory. Inventory has been an issue in terms of general real estate, not so much in terms of luxury real estate, but it is, well, I should ask you actually, is inventory an issue for luxury real estate?
Well, inventory is it is an issue here in LA County, but my other office in Orange County, actually, there's not enough inventory. So it's interesting with just an hour move away there, and also an extremely strong market out there. In my opinion, very undervalued. There is just complete different outlook as far as the market goes. So it's really all these micro markets. And, some of them, of course, have led all the way back to COVID, which, markets like Miami, which have been through the roof ever since. And also, of course, taxes pushing other places, Las Vegas, Arizona, Nashville, Texas, other places like that. Still very strong, I got to tell you.
Josh, how has the demands, or have they changed from the high-end buyer here, just in terms of what they're looking for, what their preferences are at this point? Is it different post-pandemic than what we were looking at 4 or 5 years ago?
Yeah, that's actually a pretty good question. Before it was location, location, location. Now it's walking location, walking location, walking location. That's what we're seeing out here. Everybody wants to just be in the mix, because if they are going to have their everyday life, they want to have the ease of just in case anything happens again. They want to be close to everything. So that's really what's driving the market here. Also, look, styles change, of course. What we're seeing here out in LA is the earthy tones are just killing it now. Everybody likes the very simple stuff. No more shiny stuff. That had a trend about 5 years ago, which thankfully is done now. But yeah, different neighborhoods, of course, have gone up and down. But, here where our office is in Beverly Hills, continue to be strong. But mostly, I will tell you, because we are not affected by that ULA measure that was passed in most of LA County.
Josh, I want to ask you about the impact of State Farm Insurance pulling out of California. What is the impact to the luxury real estate market, considering State Farm was the biggest home insurance provider in Cali?
Yeah, I'm not going to lie. My phone blew up when that went public over the news a couple weeks ago. It was hard enough as is. So now that they bowed out, that's going to be a real issue, especially look in those heavy fire markets where, of course, you gotta, you're paying premium for that. Now that's going to be a major blow to those properties. And because most of them here in California and some of those areas like Mulholland Drive, the famous Mulholland Drive, try getting fire insurance up and down Mulholland right now. It's near impossible. And yeah, when your fire insurance is double your mortgage payment every month, that's a big issue. That makes, you're going to see a drastic drop in those markets more than any before. So I'm glad you brought that up. Over time, we'll see who jumps back in, but it's not good.
talk about the real estate reality right now. Lots of focus on commercial real estate. Elon Musk even weighed in recently saying that there is a looming crisis in commercial real estate. We might certainly see a meltdown. How dire is that situation?
I wouldn't call it dire, but it's in trouble. Of course, the Class A buildings have the biggest problems of all because all those tenants aren't using their spaces. When I go to Midtown Manhattan, I see maybe 50% of the space occupied, and in most major cities, it's 20%. You can't keep that up. You can't pay your banker. You can't pay off the loan if your tenants aren't occupying the spaces. So everyone who's saying there's not a problem there is not being truthful. We have problems looming.
Barbara, what's a ripple effect from that, just in terms of the impact on the economy and the impact really more broadly on commercial real estate?
Well, more broadly on commercial real estate, it should make people slow down to build commercial real estate, but those commitments have been out for like 3 years, so those buildings are going to happen. So far as other, probably the biggest problem with the commercial meltdown, to use your word, which I wouldn't call it that myself, is the banks. The banks aren't going to be paid. The banks we're speaking about are regional banks. They can't afford not to be paid. And so we're going to see some banking problems, more banking problems.
Let's talk about what's going on within housing right now when it comes to the residential side of things. Higher mortgage rates obviously has kept many buyers on the sideline. What do you make of the current environment right now?
Well, it's a choppy environment and a nervous one, and it shouldn't be. I think people are coming to the wrong conclusions on buying a home right now. I think it's the absolute best time to buy a home for a couple of reasons. One, interest rates will come down again, and if you buy it now, you can refinance. And also, if you wait until interest rates come down, even by 1.5 points, I think all hell is going to break loose. Everybody will come charging the market, and you'll be paying another 10% for the house. So there's nothing in my logic that says it makes sense to wait. You ought to jump in now and get the house while you can when there's less competition, and it's still very competitive.
What does the timeline look like on that, just in terms of rates dropping and the housing prices potentially jumping 10%?
Well, the minute rates come down, who knows what's going to happen? We've had 11 increases in a row, and people are anticipating the rates will be kept steady or possibly come down. But the minute it comes down substantially, like north of 1 point, everybody's going to charge the market. That's the timetable on the whole thing.
When it comes to those first-time home buyers, many of them have been on the sidelines because they simply cannot afford houses right now. When it comes to home affordability, do you see any improvement along those lines, or what's that going to take in order to see improvement with that situation?
Well, what dictates first-time home buyers, which is the inception of any market cycle, is really jobs. And there's been tremendous job growth. There's been very little unemployment. I think there was a survey I was reading last week where they said the typical home buyer is spending another 15% of their income on housing right now to keep up with it. No, I think we have a lot of growth. I think it's very hard to get into the market for the first time. And 2/3 out of all the purchases are all cash. You know that. So it's the rich people are buying now. But I think when interest rates come down again, the middle-class people who want to get their first house will jump into the market with fervor.
What are the most attractive markets right now? If you had to name a top 3 place to buy, what would those locations
be? As a
be?
house?
As a house, yes.
Well, I would have to say Manhattan first.
But you got it.
But the Manhattan market has just ticked up. But most people don't believe that's the best place to buy. I think Pittsburgh is a phenomenal market to be buying in. Prices are up about 20% a year. The youth is coming in there, the most educated population. People are real estate friendly. There's new development. You could pretty much live very well in Pittsburgh today, which you can in New York if you're a middle-priced worker.
How do you see, with more and more people working from home, that has certainly had a massive impact on real estate where people are buying. We've seen popularity in the South and the Sun Belt region. How much of that has to do with the remote work, and what do you make of that trend as a business leader, as an investor?
That's not going to go away. I mean, the young people will not come to work full-time unless you want to settle for less good young people. If I want to hire for a new position, the first priority is, can I work from home? And we have a hybrid model. Sure, you work from home as long as you get it done. Any employer who doesn't have that attitude toward young workers isn't going to get premium workers. It's just the way it is. So that's not going away.
Let's talk about renovations. We know so many people were renovating their home during the pandemic. If they weren't out there looking to relocate, is now still a good time to make that home renovation
Yeah,
decision?
because prices are coming down. Lumber has come down. You could get the supplies you need. There was a period where you couldn't even renovate, no matter how much money you had, because you couldn't get the supplies. That has totally changed. The problem is finding a contractor. Contractors are busier than anyone else on earth. So if you find a contractor who could take your job, you're in luck.
And if you're making that home renovation, what's your top tip? What should people be considering when they are making that decision?
Make sure you have the curb appeal you want. And the curb appeal today happens online. So when you have that first beauty shot of the house, it's got to be in the best season, the best look. Even if you paint in the bushes, whatever you have to do, make sure it looks like somebody wants to come and get another peek. And once you get into the house, the two best improvements are improve on the size of your living room rug, because people will judge the size of your living room based on the rug. And the second thing is make sure you buy a new refrigerator. They will not open the stove. They will not really open your cabinets, but they always open the refrigerator.
So buy a new refrigerator.
Yeah, of course. It's worth spending a lot of money on.
We're sitting right here in New York City, an area that has a massive amount of empty buildings, office spaces that simply are not being used. What's going to happen to that?
Well, the Class B buildings have smaller office plates and they have more window space. So they can be converted to co-ops. Nobody's done them yet, but I can't imagine that not going to happen. The cities don't stand in the way of that. They want to see the redevelopment. But the Class A buildings of 25 years ago on Park and Fifth Avenue, the best buildings in town, they have a problem. They really have a problem because they can't convert to any kind of a loft space because they're huge plates. They don't have the window space. You have to have windows to convert to residential. I don't know what's going to happen with them. Your guess is as good as mine.
Barbara, what's the best way to play the commercial real estate market right now? I think a lot of investors are at home asking maybe now's the time to get in. Where are the best opportunities given the outperformance of some of the asset classes within commercial real estate? What do you think?
Well, you know, commercial isn't just office space, which everyone thinks of it as. I think the industrial sector is booming right now, and you can't get in cheap, but you can make a lot of money. Retail space, you get in cheap and you can make a lot of money, and multifamily housing is doing so well. So I would say those three areas versus the office market is the right place to buy right now.
When it comes to retail real estate, I think that has a lot of people scratching their heads just in terms of the fact that so many people during the pandemic were spending online, weren't going to stores, but shopping centers, office space, have really been able to attract those consumers back. What do you think the trick is?
The trick is that people like to touch and feel and smell what they're buying. People want to get out and see what they can buy with their hands. It doesn't mean that it diminishes the ability to order online, but the retail sector has come back at a lower price, but it's come back definitely because people want to shop.
Let's bring in Chris Porter, John Burns Research and Consulting Senior Vice President. Good to have you on today, Chris. So walk us through what that supply-demand dynamic looks like right now.
Yeah, I mean, we've got some pretty strong demand for housing. Obviously, people want to, they've got to live in a house, right? And we've got a growing population. The challenge is just the supply is not there, especially on the resale side. We are at a very low levels of resale supply. And, I think that's actually created a bit of a floor on how far prices could fall, at least temporarily. And also, it's given some more market share to the home builders. The new construction has really kind of been able to step in and represent a bigger share of the inventory available for sale. And that's why you see, the builders doing quite well right now.
And so I believe it's by your calculations, we need 17.1 million more new homes over the next 10 years to meet the demand. Are we going to get those houses? Are we going to actually see that many be built?
So the affordability plays into this in big ways. And that's under sort of normal affordability conditions. We are still not in normal affordability conditions right now. People are still paying a greater share of their income towards housing than they have historically. And the way that you bring affordability back into check is one of three ways. You either raise incomes, you lower mortgage rates, or you lower home prices. And we really haven't seen prices come down all that much. That differs by market, obviously. Incomes are still growing pretty solidly, but mortgage rates remain, high, and that's been a big challenge in housing right now. Where the new home side has been able to benefit from that is by offering some of these rate buy downs and getting buyers in at lower rates.
How quickly does that supply need to come online in order to bring those rates down, and how do we get there?
I think once rates start to fall, and we think they will. I think we're not going back down to 3% rates anytime soon. And I think that was indicated today in the Fed announcement that, we're not going to see the Fed funds rate come down anytime quickly. And, I think mortgage rates are going to stay elevated beyond what people have been used to over the last several years. And so what it's going to take is to get the demand, to get the construction there. I think the demand will play out over time, but we're probably going to see less household formation in the short term until people can feel affordability is in their favor and they can purchase a home.
Do we also need to fundamentally reset our expectations of what home ownership, what percentage of Americans will end up being homeowners?
I think it's interesting. So you've got sort of two ends of the spectrum here. You have this massive wave of older adults who have 80% home ownership, and that's a number that's getting bigger. As older adults age into their later years and very high home ownership. It's the younger adults that have that lower home ownership rate today. We've seen a little bit of an uptick in the last couple of years amongst the younger adults, just as they had more money in their pockets through government stimulus, as mortgage rates were sub 3%, many of them were able to get in. But I think with rates staying high, it's going to be a challenge for homeownership to rise in the near term until that affordability measure gets a little bit more into check.
Well, and to add on to that, if you talk about supply, we talk so much about single-family homes, single-family units, but it really is about multifamily units as well, sort of becoming increasingly the only option for any kind of ownership. If you sort of look down the line on where things have been moving, what does that mix look like?
Yeah, so I mean, think about it. It's about 2/3 single family, about 1/3 multifamily in terms of the new construction. We've got a lot of multifamily in the pipeline right now that's delivering to the market. I do think we're going to see a bit of slowing in multifamily over the next several years. And we do think that single family will probably won't slow by as much on a percentage basis here in the next couple of years, as we have this group of millennials that's moving into those years where they're purchasing homes in bigger numbers, and even that Gen Z group moving into those home buying years. We're seeing more shifting towards that single family. And so we'll start to see that balance probably remain about the 2/3, 1/3 split. But certainly we've got a lot of multifamily coming online right now.
Chairman Powell, I think what he said, there's definitely some truth to what he said. But as you say, the market has been painted with a very broad brush. The office market is not performing well, and there are some concerns there. But outside of the office market, we have really strong fundamentals. Frankly, some of the strongest fundamentals that we've experienced on record, particularly in the industrial space and the residential space. And if you look at our portfolio, just to put some numbers on it, just in the last quarter, we had 50% mark to market in rents for the new leases that we signed in the last quarter in our industrial portfolio. In our residential portfolio, we're 94% occupied today, which is the same occupancy that we had in the fourth quarter of last year and headed into a strong season. We're still seeing rental rate growth, NOI growth of 1 to 1.5% a quarter in our residential portfolio, which is really historically very strong. It's not the 5% that we saw per quarter in the 21 and 22 timeframe, but it's still very strong. So we have really a bifurcation, I think, in terms of performance of the office sector on one hand and the other sectors on the other hand.
And Kathy, I want to bring you in here for your commentary on that too, and where you're seeing some of the strongest and weakest performing sectors in CRE.
I think from our perspective, and obviously where we're pulling from our sources, data and information, what they're seeing day to day, I think the office sector is obviously the hardest hit, and particularly Class B office. That's where we're seeing the biggest pain points, and I think there's no surprise there. The headlines have always been full of negative headlines around Class B office, and a big part of that obviously is this looming maturity wall, this $1.5 trillion maturity wall that's coming our way over the next couple of years. And the reason behind the office sector is most worrying is because these assets really are going to have the hardest time to be refinanced today. On the other side of the coin, I think multifamily, industrial, we're seeing do very, very well, and they've actually performed very well for the past few years. And I'm sure Hassam has some data around that, but it's really they've been two sectors we've seen consistently outperform the other asset classes within commercial real estate.
So Hassam, do you think this doom loop that we keep hearing about CRE then is overstated, or perhaps people really aren't understanding the nuances when you break down the different types of CRE?
I think the differences by property type has been well stated by my fellow panelists, and we concur with their observations. What is concerning at a macro level is the contagion from office to other property types in the way that it may affect credit availability and banks and other lenders. And we've already seen a major pullback by lenders in general, even though all the other property types outside of office are performing well. They have become so much more cautious, and the credit flows have become even more constrained than they were going into this year. That is affecting the whole industry. And when there is less credit available, there's less trading, and that has become problematic for a lot of our clients across all property types. They are pivoting. Those people that see the future in their favorite property type, favorite market, or favorite asset are finding ways to acquire those assets if they're priced right. And the good news is we're starting to see some price adjustments. We're starting to see some more reasonable expectations because of higher interest rates come back into the market. And when the alignment between buyer and seller is there with the right price adjustments, we're seeing transactions occur with less leverage, more equity, because again, people are believing in the long term. Even for office, there is opportunistic investments for office. I think the more important thing is the macro economy is doing well. Inflation is coming in. We don't believe the Fed is quite done yet. This was maybe a skip. So when we get the clarity of the tightening cycle really coming to an end, I think all of this will come together in a way that will start the next cycle. But in the meantime, there's just overall cautiousness by lenders in general.
what's the outlook here for rental levels?
Yeah, well, when we're looking at the rental market right now, especially depending on where we're looking, you're balancing a few things. We had a lot of migration over the course of the pandemic, a lot of reasons to move. That's probably starting to slow down. We've also seen some areas that have delivered a lot of new apartments. Construction in the multifamily space was very hot and heavy over the course of the pandemic as well to kind of meet that need and meet that demand. So now where we're looking, there are areas where rent continues to be soft and even is possibly falling, on a month-over-month basis. But that is more and more rare as actually we start to see things in the rental market heat back up. It's softer than, say, a pre-pandemic month, but certainly much more pressure than, say, 5 months ago. Now, when we're looking at that and we're trying to understand, what is happening, there is a headwind to the rental market from the mortgage rates within for sale, as we just have a big buildup of people needing homes. This is a massive generation of millennials that are putting pressure on the market. Just to put a number in your mind here, if I think about all the households that are living within, families, individuals, and couples that are living within other unrelated households, you're looking at 3.4 million. That's a lot of underbuilding. So the fact that we continue to see pressure come back on rental markets, softer than pre-pandemic for sure, but still rental price growth that's, on par with a pretty steady growth.
This is almost the second day in a row where I'm summoning Jimmy McMillan into the conversation because the rent is too high. At the end of the day, Skylar, when you think about what type of capacity needs to be brought online, what are some of the time markers that you would be looking at?
Yeah, in terms of time markers. So you mean like when we need these kinds of things? I mean, absolutely right now there's an emergency for many people. If we think about like what it means at a household level, then I'm going to talk about the typical household. So for many households, this could be much worse, right? Over the course of the pandemic, you might expect that rent would take 3% more out of your paycheck every month. Now you're also dealing with general inflation at this time. So households are probably finding it increasingly difficult to save. That puts them at financial instability, especially if you're expecting to go towards, say, a recession, or you might be a bit more concerned about job loss moving forward. So, in terms of the needs for a break to American households, the time is most certainly now. In terms of timing, like how long we might be in this crisis, we inherited it, in the beginning of the pandemic. It was here. We were already talking about it. And then in terms of moving forward, we might expect to see a lot of pressure on housing for the next decade when we talk about generational flows.
And you note this less competition for rental units on the market as people do sort of tighten their belts, perhaps taking on a roommate, trying to do other things like that. So at what point do you see that also then affecting rental prices? Will they start going down then as more people start doing that?
Yeah, I mean, I think what's happening right now in different rental markets, there's actually some unwinding probably going on as we start to see new supply. But a lot of that new supply was in places where we were seeing a lot of good growth, inflow. So when we think about what, metros are receiving a lot of inbound population, those areas are often the places where rent is continuing to grow and people continue to have to pursue strategies like that, right? That $3.4 million number that I mentioned, by the way, not dollars, 3.4 million families or couples or individuals that are living within other households. So say doubling up with a non-relative, those are non-relatives. There are plenty right now, and we saw over the course of the pandemic, this surge of people that go back to live with family, of course. So the boogeyman in every boomer's basement is their, millennial adult son, right? Just kind of saving up to get financially stable. And potentially saving up to try and enter a for sale market that is also increasingly challenging, especially at the lower affordable end.
That is an amazing image, Skylar. I want to ask how all of this feeds into the big picture and the Fed's inflation data that they track, right? Because
Yeah.
We talk a lot about so-called owner's equivalent rent as a proxy, right? But here's actual rents that we know what's going on with them. So it sounds like that this is not going to be something that helps inflation decelerate in the near term.
Well, I think so. I look at this every month as something I get very excited to refresh. This graph that I track that looks at that month-over-month pace within the shelter components of CPI, both for renters and owners equivalent rent. And I look at that month-over-month pace of our Zillow observed rent index, which, as you mentioned, yes, tracks real asking rate rent. So it does not include concessions. So we do, other analysis on that to see there are absolutely places that are offering more concessions, but market rate rent, we did start to see those shelter components of CPI start falling at around a year lag after Zori hit this fever pitch, towards, the fever was kind of towards the very beginning of 2022, end of 2021. Once that fever kind of broke on that rental market, 10 months later, you see those shelter components of the release market, which dominates the CPI measures that are across the full housing stock. So, okay, what do I expect today? If I look at those month-over-month shelter components, we're about less than halfway back down to, say, a pre-pandemic pace in the release market. We are softer than pre-pandemic in those asking rate rents. So I think that's a good sign for the overall general inflation that the shelter component pressure is easing. It's not going to be a source of incredible softness in general prices, but it is easing relative to those pandemic, highs and heat. And that should help the release market continue to soften down, but maybe more slowly than we wanted.
ADU. That has become a critical part of the real estate conversation here in California. And put simply, they are backyard units that function much like a single family home. We are actually inside one here. This used to be a 2-car garage, and the homeowners have converted into a 500 square foot space. You see, we've got a kitchen here. You walk over to the corner. We've got the bathroom. And then I'm going to give you a quick tour on the other side here, because there is a bedroom also attached to this unit. All of this done in the backyard here. And the reason we are seeing so much growth in these units is because of a law that changed back in 2017 here in California, legalizing the permitting of ADUs, and the numbers really tell the story. Last year alone, 23,000 permits for ADUs issued here in California. That is a 60% jump year on year. Here in LA, the numbers were even more staggering. the number of ADU permits issued were 5 times that of single family homes. And the growth has become so big here. Even the co-founder of Airbnb, Joe Gebbia, has jumped in on this space. He launched a company called Samara last year. I spoke to him about the opportunity he sees in this space. Take a listen.
You could say that the idea of ADUs has become culturally popular, especially since the pandemic, because people's values towards their homes have shifted. They've changed. 58% of Americans still spend at least 2 or 3 days a week working from home. And currently 1 in every 5 households throughout the United States has 2 adult generations living together. So these are big shifts in the way that people think about home. And I think as we've seen these changes, we've also seen governments get behind this, because ADUs to governments are providing horizontal density throughout cities and neighborhoods. And so governments have changed laws to make it even easier for people to get ADUs. In fact, they're basically making it a right to have an ADU in your backyard. And as you mentioned, in California, they changed the laws in 2017, and since then have had a 17x increase in permit applications. That's phenomenal growth. And so I think it shows that there's a demand there, and that the easier that you make it for someone to have an ADU, there's clearly a market.
So talk to me about how Samara fits into this market, because you've got a template in place. How does it all work?
So the way it works is you go to samara.com and you configure your backyard unit. We have a studio, a 1-bed, and a new 2-bed unit. And so just like you would configure a Tesla online, you configure a Samara backyard unit. And when you hit order, we receive your order, and we go through a process where we handle everything for the customer. So that's both the construction of the unit in our factory, but it's also the hard stuff, the heavy lifting, the things that homeowners don't want to deal with. That includes permitting, soil samples, utility hookups, and a very long list that a lot of consumers, when they see that list, they say, you know what? They throw their hands in the air and they say, I'm not an expert in home construction. I don't want to deal with this. And so what we decided as part of the Samara brand is that we would take care of not only the structure, but also the service. Also everything that gets in the way of people saying, well, I'd like to have this extra space in my life. So we decided to do everything. And so after we get the order and we go through the whole process, we produce in our factory, we ship it on our truck, and we crane it in to the specified backyard.
I know it's been just over 6 months since official launch. What does that demand picture look like, and how concerned are you about that pulling back along with the demand in the housing market overall?
Well, they're all commensurate. But I think what you'll find, what we've seen with people who want ADUs, is that it's actually a phenomenal income generator. And the majority of people get an ADU in their backyard to rent it out and to generate income. So it's a trend that I saw at Airbnb of hosts renting out backyard units. And it's a trend that we see more and more now that we're in the industry, because it's kind of a no-brainer. If you're a homeowner, you've already paid for the land. And now that we've created this simple offering where you can literally just order online, and we handle everything for the consumer and for the homeowner. It's a fairly clear proposition of a way to make some extra income.
When you think about how the law shifted in California specifically, it was about addressing the housing crunch, the shortage there, and having more units. But I'm looking at a price point for Samara, and correct me if I'm wrong, it's roughly, what, $300,000 if we're looking at a 1-bedroom to 2-bedroom unit?
That's right.
I mean, that's a pretty high price point, even if we're looking at additional housing, trying to bring the cost down. I mean, how significant a dent, when you look at ADUs overall, do you think it can make in the larger issue of housing supply?
Yeah, look, I think it's going to take a lot of different ways to attack housing, not only in California, but across the country. I think this is one of many options that governments and developers have to make a dent in the problem. And the price, for California is fairly competitive when you take into consideration labor costs and the fact that we're doing everything for the customers, not just the construction of the home and the materials. It's actually the permitting costs and the water hookups and all of the nitty-gritty things that a customer has to pay for.
California's gotten a lot of attention around ADUs just because of the sheer number that you pointed to in terms of permits that have been given on ADUs. But we know a number of other cities, states have also been looking at this too. I mean, how much of a template do you think this can be for other states, whether it is on the West Coast or in places like Texas, to address the housing supply overall?
Well, in true fashion, California is ahead of the curve. They are leading the way on this, and other states are following. There's been at least 8 other states that have passed laws very similar to California's. I know Texas is evaluating some ADU laws at the moment, along with a number of other states across the U.S. Because, again, governments realize this is a fairly simple way to add more horizontal density. And the other point is that not only governments love it, but neighborhoods love it as well, because in California, cities have mandates to add more housing over the next couple of years. And neighborhoods love ADUs because rather than putting in, a multi-family mid-rise in the middle of the neighborhood, they can actually add the similar amount of density without adversely affecting the visual character of the neighborhood. So it's a win across the board.
What does that mean for Samara moving forward? I mean, I imagine that really opens up the market for you beyond California, where you got started. That's right. I think we are well positioned to tap into this existing customer demand. And I think we'll actually expand the market by making it even easier for people to acquire a dwelling. And the other thing of why I think there's market growth here is that people are using this not only for income, but for a multitude of other reasons and use cases. And if you think about how life changes over time, what having extra space in your backyard could provide for you. Sure, it could be income on demand as you need it. There's also use cases of housing elderly parents close by, of housing college graduates when they come back post-graduation, of working from home, having a quiet, productive space, quiet, productive office right in your backyard. So I think the benefit of this form factor of housing is that it can be many things, and it can actually adapt with people over time, depending on the needs that they have in their life. Walk this direction, because that'll give you some perspective on where they are being built. That's where the ADU is. This is where the actual home is. In some cases, you've got homeowners who are actually living in the ADU so they can rent out the main home as well. Now, the housing affordability issue really has driven the growth that we've seen here in California. And it's worth noting that the average, or we should say the median rental here in California is 41% higher than the national average. But one of these units can go and rent for anywhere from $2,000 to $3,000 a month. So that's raised some criticism from those who say, look, this isn't exactly affordable housing. We should note it's not just California. Denver, over in Colorado, the most recent city to pass changes to their zoning laws to allow for more ADUs. We've also seen changes in states like Washington State. So this is something that is really taking shape across the country as we look at the housing crunch, supply crunch, as well as the affordability issue. By the way, the next step here in California where people are looking at is the potential for homeowners to be able to sell one of these ADUs. Right now, it's strictly limited to rentals. If they can actually build out the unit for roughly $300,000, potentially sell it, that'll really open up the real estate market here.
Brad Smith, Brian Sazi, and this is no normal programming you're tuned into right now on Yahoo Finance. Cannes Lion Festival of Creativity taking place here in 2023 was unlike any other event that you've seen on this network. And guess what? We've got the conversations with the biggest executives who made their way to Cannes and were at least here on the beach with us for a little bit.
Bottom line, if you want to make money and grow your wealth, watch all of these interviews.
We are here with Kevin Hart, actor, comedian, entrepreneur, and founder of Heartbeat, as well as the Heartbeat CEO, Ty Randolph. Great to have you both here with us today.
Great introduction.
This guy's a pro.
Great introduction.
Well, first and foremost, we got to come correct for the Entertainer of the Year. Cannes Lions 2023 Entertainer of the Year. What does that mean to you?
Mind-blowing. You know what, man?
It's about time. No, I'm joking. No, you know, it's a great feeling just to be recognized in any capacity. It's not something that I allow to get to me too much, but to be able to come out here, have an opportunity to meet all of the amazing companies, brands that are here for the sole purpose of networking and growth upon relationships, to be able to come out here with my company and have a stance and opportunity to really just have a staple for others to have an understanding as to what we do, what we are. That's the bigger side of opportunity here. The Kevin Hart of it all, I love it. I appreciate it. I'm humbled by it. But the opportunity is more of a heartbeat opportunity, and that's what I'm more excited about.
Ty, how do you take Kevin's energy and a brand that really everybody loves and weave it into a business and take it to the next level?
So not alone. We have a brilliant team of executives across creative, brand partnerships, our infrastructure, legal, finance, you name it. It really takes a village or an army, if you will. But, you know, a heartbeat, Kevin's the North Star and sort of the heartbeat of the company. Like, he sort of sets the tone, all of the energy that you see going into his work creatively from an entrepreneurial perspective. We really try to harness that, but not for the sake of building, you know, Kevin more. He always says to us, I'm not going to be any more famous than I already am. But really, it's about opportunity creation for the broader ecosystem of talent that's out there. We have amazing partnerships, and we're working with so many amazing creators across audio, TV, film. And, you know, I think what's really exciting about Heartbeat is it serves as a platform that he's created for the next generation of not just comedic creators, but just creators in general.
Ty, when you think about the business landscape right now and the executive makeup,
yeah,
we're still a far way from seeing more women in leadership, more women of color in executive positions.
Not at Heartbeat.
Not at Heartbeat.
Not at Heartbeat.
And so the fact that that has been prioritized and that you've been entrusted with this role, but you also already had the skill set even before getting into this.
I was going to say, let's make that very clear.
Absolutely.
That she's been entrusted with a role that was deserved. You know, opportunities are earned. They're not given just because. And just before Ty takes it and has a well-deserved moment to talk, you know, in regards to what you asked, I just want to highlight, like, the priorities of today for the entertainment business were our priorities yesterday, right? Like, at the beginning stages, we wanted to be an example of the change that we wanted to see. So our infrastructure is one that's full of color, that's full of a variety of creatives, and a landscape of inclusion, right? Because that's what it's supposed to be. Not because we're being told to do so or because there's a spotlight on it and other companies now have to alt and maneuver accordingly, but just because it's the right thing to do. So I just want to make sure that, like, the idea of what Ty Randolph is so dope because she sits in the seat that's not only deserved, but created by her hard work. Like, you're talking about a woman who fast-tracked her way to CEO and who's been underneath my infrastructure for years and started out in one position, was promoted so many different times to the point where I said, hey, man, I think it's best that you just run this.
Ty, did you see this happening? Did you see yourself in this role 10 years ago?
Oh, definitely. So I was going to be running something for someone or running something on my own. But, you know, what's interesting about this, what Kevin is saying, is really important, I think, for this to land with, you know, your audience. And, you know, we say this with our peers and we try to constantly recommit ourselves to this mission. I joined as head of marketing for one of the companies that we merged to form Heartbeat. I was promoted, was it 5 times in 6 years? You know, from SVP of marketing to then take on monetization, EVP and GM, COO, and then CEO of 2 companies and then CEO of the one. And what was interesting about that is it was a complete meritocracy, right? It was, if you earn it, then you get it.
Absolutely.
And so often there are folks who are earning it that don't get the opportunity. And when I was appointed CEO, Kevin said one thing to me: let your story here be the rule and not the exception, right? And so my KPI as CEO is really opportunity creation. Everything I do, from, you know, when we're talking about the bottom lines and we're talking about our creative output, the hiring of our team, it's all about how much value can we create create in this ecosystem for our team members, right? The folks who work here, for our partners, the folks who we have commercial partnerships with, for our investors. And we have to constantly, and that's something you earn every day, right? Whatever we did yesterday doesn't count. But this idea of creating a meritocracy, because that's what we want in the marketplace, right? As long as we're driving subs and buzz or brand lift and recall, we want another opportunity to earn it. And so that's what I was given, and that's, what I've committed to providing.
Amen to that.
She's done an amazing job. We're unbelievably lucky to have her, and I can say that the energy from the top truly does trickle down. And we have a hard-working unit, right? We have a hard-working unit that is aligned with the clear directive of scale, of IP, of ownership. And that opportunity, I love it. It not only has presented itself, but it's transformed into people understanding like the stars of tomorrow should come from underneath our umbrella.
Yeah.
That's a service that we want. What's the gateway? What's the new bridge to opportunity for your writers, directors, actors, actresses? Like, what is the gateway? What's the new position that we can put people in to ultimately succeed and find their version of a star? If we do that correctly, then we're part of bigger conversations, and that's the priority.
Kevin, I think a lot of executives, CEOs, and chairmen are going to watch this, and they're going to look at you and say, how do I drive that change from the top? I don't have an operational role in a company per se, but I want to drive change throughout my organization like Kevin Hart has. What are the steps they can take?
I think the first steps is be welcome to the opportunity of, right? Like, what you don't know, you don't know. And the best way to discover what you don't know is by listening, by informing yourself, and being open to the idea and concept of change. And that change has to come with personnel. It has to come with ideating at a high level and acceptance to what that looks like. I am not the smartest man in the world. I will never put myself in a position to claim to be that. But what I am is an amazing team player. And the team that I can say that I've been able to put around me has helped me create this thing. It's a team engine. It's a team concept. And for all the change that we are a pure example of, it's come from the concept and idea and understanding of what people have brought to the table. It's not all Kevin. And if it was, then we would be in a bad position because I don't have that much time, energy, or effort that I can put in a day-to-day. I have to embed upon the world of opportunity that's brought to me from the people that I have at the table. They're there for a reason.
Kevin and Ty, I want to end on a fun note here. We've come up with a little game of this or that.
5-5.
Yahoo Finance Edition.
6-2. Wait.
Ready? All right.
Sorry.
This or that. Yahoo Finance Edition starts now. First question. All right. You have a partnership with Motor Trend, so this was inspired by that. Bronco or Cybertruck?
Oh man, you gotta go Bronco. When you talk about trucks in general, the foundation of a Bronco and the original foundation of a Bronco, you just don't get better. As you know, I'm a classic car guy, real car enthusiast. That's why my answer was a little broken down. I apologize.
Bronco as well?
I guess.
Bronco.
Yes, okay. Second question here. Better business person, Elon Musk or The Rock?
Oh, that's a good question. You know what, man? You're talking about two entrepreneurs. There's no such thing as a better. Creators create. And you're looking at two people that love to create, and they've done it on very high levels. So I beg to give an answer of either or. I embrace the world of what they both have.
How about this one? Any investing advice to The Rock?
Yeah. Do better.
Kevin Hart, Ty Randolph, thank you so much for being
Thank
so
you,
generous
guys.
with your time joining us here at Yahoo Finance.
Great conversation.
Thank you so much.
Thank you.
Welcome back. Yahoo Finance here at Cannes Lions Festival of Creativity. And joining us now, we've got a great one for you folks. Tarek Hassan, who is the Chief Marketing Officer and Chief Customer Experience Officer at McDonald's. You know him. You love the arches. Thanks so much for taking some time.
Thanks for having me. Pleasure to be here.
Absolutely. All right. Without kind of belaboring this, we got to ask, because everybody wants to know about Grimace. Can we talk about Grimace for a hot second?
We can absolutely talk.
Okay.
It's about Grimace, right? And Yahoo Purple. So,
it is.
You know, we're in color.
And so, I mean, yeah, I think about Grimace. I think about my own Philadelphia sports fandom. We grew up with some questionable mascots growing up. We had the Philly Fanatic. We had Gritty. People wonder what they are. People wonder what Grimace is.
What does Grimace represent?
Yeah, so well, first of all, Grimace represents joy and happiness, right? And the way he shows up. But a lot of debate over what Grimace actually is, even in our own culture, and a little bit of lore. But, you know, the lore is that he represents a taste bud.
So it is a he.
Well,
you're right, Brad. I didn't
realize
realize it was taste bud. I'm an 80s kid. I didn't realize
so
that.
he's a, supposedly a taste bud, but he's joy, right? I mean, if you think about the happiness and the joy he brings, and he's kind of that McDonald land friend glue, keeps everybody together and optimistic, and we love bringing him back. People are having a great time.
So I've seen Grimace really explode on social media over the past few weeks. How does that translate into the business of McDonald's? Do you see a pickup in traffic because of this? Really, you've hit a cultural moment with this character.
You hit on the bigger issue, which is the leverage of culture in general that we're driving the business with, and I use that word very specifically because it's one thing to connect with your audience, but look, at the end of the day, our responsibility is also to drive the business and make sure we're showing up for our franchisees and growing the business. What we uncovered actually a few years ago when Morgan first launched Travis Scott and our famous orders was an awakening of the brand. Mm-hmm. People reconnecting and realizing that there was a value to this brand that frankly I think we had forgotten, and we had lost a bit of our swagger. But what it really untapped for us was the power of culture. And that's a big word, everyone uses it, but we set that as our North Star to really become a cultural icon. And we talk about meeting culture at the intersection of commerce, to your point about driving the business. But that's a big word. So what do we do with it? And we talk about it in 4 areas. We're a food company, so of course we're going to impact the taste of culture. We want to live in the culture of our fans. We're leveraging data to create value, which creates long-term relationships. And with a digital first generation, that is culture with them. And then we're McDonald's, so we shouldn't just be participating in culture, we should be creating it, which means if you're going to do it externally, that gives you a thought to how you have to build that culture internally. And that's really what's been the driver of the business for the last 2.5 years.
You mentioned the Travis Scott collaboration. That was just one of many. It seems like there's one that's coming out every other week at this point, but they're some of the most famous musicians, entertainers, people who are already circulating within homes on a daily basis and around the world. And so, from a McDonald's perspective, from a business person's perspective, how does that translate into quantifiable returns for the brand?
Yeah, well, first of all, it starts with who you choose to work with. And for us, while the list of who you rattled off are some great folks, what's fantastic about them is we're not working with them because they're celebrities. We're actually working with them because they're actually fans of the business already. And that's why you're seeing we don't just partner with them, we actually collaborate with them. And we're turning the pen over them. So in the case of Travis Scott, involved in the design, package design, involved in the merch design, BTS, same thing, Mariah, and the thing is, all those meals are theirs, right? And so what you're really doing is tapping into the fact that everyone's got their meal that's their favorite, and this gives you a chance to tap into the these celebs that you love as fans and taste a little of their favorites. And what we are seeing is absolute translation into the sales and the growth of the business.
What's next on the partnership front?
Oh, you're going to come at me on that, are you? So here's what I will tell you. It's not another famous order. You probably have seen your last famous order for a little while. We had a great experience with that. You're going to see us continue to tap into that childhood loss that you saw us do last fall with the Adult Happy Meal and with Cactus Plant Flea Market. We're going to continue to play in that space, and you're seeing it today with Grimace, and that was a really good way of me dodging telling you specifically what's next.
So why?
Because I got a surprise and delight.
Why target? I guess you're kind of targeting me. I guess an aging millennial. Why such a focus on that demographic, and why are you so confident you can get that customer back in the door?
So here's what's great. We're actually targeting multicultural youth, and we had a real down cycle on how we were doing with that segment. So that 17 to 34, 17 to 24 kind of range that's really important, and really also thinking about the multicultural youth. And you think about the youth market today, the most diverse market we've ever seen as a generation. But what we're doing is we're tapping in and understanding that fan relationship, and then we're wrapping the executions around things that have a little more universal appeal. So that Happy Meal experience, no matter what generation you were, you understood it and you related to it. You wrap a cactus plant flea market over and you connect with the youth market. You tap into the insight around the Happy Meal, and I remind you of your youth. And so it's really a reflection of how this brand just has an incredible universal emotional connection with folks, and you just got to wrap it up in a way that anyone can find their way to connect with it.
At the same time, people think of an environment like this where the recession word is thrown out there in every other conversation seemingly. Yeah. And they're trying to find value in their purchases, especially in the food that they're putting into their bodies, that they're going out and giving to their family as well. During a time where consumers are looking to McDonald's, how does that either elevate the marketing spend or cause you to be more judicious about where you're spending?
Yeah, look, I think the good news is for us, we are a brand that people have always expected that affordability and value, and we show up for our customers to deliver that for them. But we're living in some pretty unprecedented times in terms of what that inflation looks like. And so we continue to ensure that we've got offerings on the menu, whether that's our value meal offerings or how we think about pricing in relationship to the market, and ensuring that we're listening to our customers. Even the way we approach our pricing strategy is through the lens of understanding what our customers are willing to deal with in this environment, and make sure we're there for them. And we're accelerating through this time where others are struggling. And the scale of our organization allows us to pass on that benefit to our customers, and that's something we're going to continue to do, frankly, recession or not.
As you look into the presidential election cycle next year, we're getting a lot of a different range of opinions. A lot of marketers are telling us we're going to continue to be out there front and center. Others, I think, have suggested to us they're going to pull back. From a McDonald's standpoint, where do you stand? Do you want to see an ad for a Big Mac placed next to, let's say, an article on a Biden-Trump re-election run?
Look, I think for us, whether it's an election year or not, we line the brand up around some pretty specific brand safety approaches and values for the brand, and we line those up against the media strategy for everything we do. We're a brand that, like 90% of the country walks through our doors every year, and so we are one of the most democratized brand in the country, which means we just have to be in a place where we represent that relationship to everyone. On the whole, we don't tend to spend a lot in the news space. Frankly, it's just not where our customers are, and it's frankly not where the values of the brand sit. And so I think unlike certain brands that are maybe trying to figure out how they juggle that, we know where that place is, where we meet our fans, where they're contextually thinking about us, and those are the places we're going to be. What I will tell you is we don't envision any kind of slowdown in how we're approaching the growth of the business, and continue to support it because it's working, and we're seeing it both in terms of our sales, but also what we're seeing in terms of fan affinity for the brand.
Are the chicken sandwich wars done?
No, make no mistake, and we're really thrilled. We continue to steal share in that side of the business. It is going to be as robust as the burger business is. As you look at the consumption of chicken in the country, it continues to go. We are not taking our eye off the ball. We got a great sandwich in McCrispy.
Well, you have a different philosophy, I think, in chicken sandwiches. You have the spice in a dressing on top of the chicken. Everybody else breads it in. You know, I consume these products.
Well, you remember we carry two, right? If you're a longtime lover of a McChicken like I am, that's got that great peppery batter right on it. Yep. But then the crispy chicken gets you into the larger patty and a whole meat sandwich that people just love. And so we think we're going to continue to play there. And of course, we've got our famous nuggets, which nobody comes.
Brad, he did his job. He sold me on a sandwich.
Facts and the nuggets at the same time. Thanks so much for joining us.
Hey,
here.
It's a real pleasure to talk to you guys. Thanks
Absolutely.
so much.
That's McDonald's Chief Marketing Officer and Chief Customer Experience Officer Tarek Hassan joining us here at Cannes Lion Festival of Creativity. We'll toss it back to you in New York. Another big issue here at the Cannes Lion Ad Festival, against the backdrop of Target and Bud Light controversies, is how companies are navigating their brands through an increasingly polarized world. We spoke to some big brands about just that. Brad Smith here with Brian Sazi. You're watching Yahoo Finance, and we are here at Cannes Lions Festival of Creativity. Joining us now, we've got Jane Weekly, who is the Chief Consumer Marketing Officer and Chief Growth Officer of International Foods at the great brand of PepsiCo. Thank you so much for joining us today.
It is the longest title in history.
But it's a great one. You
I'd
wear
like
many
to
hats.
rebrand it. You know, Chief Smiles Officer.
Well, you're in charge of marketing. You could do that. You could rebrand your
You know
title.
what? I'm working on it.
Well, you're bringing a lot of people smiles already through both beverage and snack, but now you're going to bring even more people smiles through soccer, or should we say football?
Oh, nice. You've been doing your homework. Did you like that spot?
I did.
Soccer versus football? Okay, yeah, no, we've got some very exciting news to break here at Cannes. We're actually announcing that we've just signed again with UEFA Champions League for the next 3 years.
Wow.
For both beverages and our foods business, which we're incredibly excited about. And actually, I was at the final in Istanbul 2 weekends ago. And, you know, the energy and the difference we can make for our brands, for our consumers who we serve, but also for people and planet through this partnership, we're super excited about. So, like at Istanbul, I attended the Gatorade 5v5 contest as just one example.
Mm-hmm.
And, you know, we've now touched 120,000 young people's lives through that. And it's all about driving access to sport in line with Gatorade's mission to fuel everybody, and just seeing the impact that sort of initiative has on young people's lives. We're very excited to be able to do things even bigger, even bolder in the next 3 years. Wembley next year. See you there.
Yes.
Well, how will you show up? How will your campaigns look different over the next 3 years?
Well, you know, you can already see we're very intentional about driving diversity, equity, and inclusion in sport. So just as one example, you know, this year we really used our brands and their reach and impact to elevate female access to sport and the female game. So, for example, in all of our big campaigns on Pepsi and Lay's, we featured both the male stars and the female stars. So on billions of packs around the world, you not only saw Messi, but you know, you also saw Lieke Martens. In our campaigns, you saw Lieke Martens, Thierry Henry on Lay's, Leia and Vinny on Pepsi. And you know, it's really important that we believe if you can see her, you can be her.
About time, Jane. I'll just say it, about time.
Thank you.
Good stuff.
Thank you. Yeah, so we're really excited about that. And we've got big plans for Wembley, so book your tickets now.
Done. You heard it here first.
And it's the first time the female game, the female final ever sold out, record-breaking attendance. And so, you know, I'd really encourage you, book your ticket for both now.
That is going to be my next concur charge the second we get back to the office, Jane.
Nice.
You authorized it.
Yeah, absolutely.
So as we think about what you're seeing in the customer right now, how would you define this customer across the categories that you're looking across at PepsiCo? Because we've continued to hear that the customer is resilient in their spending. The customer is healthy. How do you see them from your perspective and the executive teams?
You mean what we define as consumer, I think, like so the people we ultimately serve. So look, our brands really democratize pleasure, democratize joy, democratize better for you approach to both snacking and beverages. And so our brands have very high reach. So, you know, our penetration from a portfolio perspective is over 90% of all households in many markets. And therefore, you know, we need to really be close to the people we serve and their needs. And what I'd say is we're lucky to be in categories that are very resilient. You know, people are still enjoying the beverage, enjoying a snack. And, you know, we're leaning into that, but we're also leaning into the differences in the consumer's needs. So we're providing choice. So, for example, we're increasingly dialing up our offering of zero products on the beverage side. We're ensuring that consumers have a choice and can really opt into whichever part of our brand suits them best. And so that type of offering is really important to us. And on the snack side, you know, we're working hard to reduce sodium, reduce sat fat, for example, to ensure that, you know, actually when you enjoy a bag of chips, you're enjoying it in the very best way you can. And, you know, removing those slight niggles which might hold you back so that you can really enjoy more often.
For the past 4+ years, after every earnings call, we have talked to your longtime CFO and Vice Chairman Hugh Johnston, and he has told us repeatedly, snacks are on fire. They're hot. Everybody likes snacks. Everybody's snacking. So I'll put this to you. What is the secret ingredient behind keeping snacks hot, Because when I walk down an aisle, Walmart, Target, Kroger, Albertsons, you name it, this is a competitive section. How are you giving a guy like Hugh these results every single quarter?
Well, it's putting humans and people at the heart of our business, both in terms of who we serve, the consumers, but also, I believe, the people that work at PepsiCo. You know, ultimately, we are there to serve our consumers, and we're working hard to delight them with the product quality, delight them with the entertainment, and be highly visible and meet their needs, right? We're moving with the times in terms of how we reach them, in terms of the portfolio we're offering, and that's keeping us highly relevant. So yeah, snacks are on fire, that's for sure.
And what about in the messaging? Because for some brands, they've gotten it incorrect by wavering on their messaging, that they're hearing their internal constituents want the brand to stand for and represent, and their external customers and partners that they also want to hear them take a stance on. How do you approach that at a very polarizing time like this?
Look, we're true to, firstly, I think it's really important at PepsiCo, we're very true to who we are. We have, you know, one of the reasons I joined the company was the company and everyone that works at it has deeply held values. And we, you know, really strive to be very consistent with those values, whether it's an internal people decision, a brand decision. And as far as our brands are concerned, I think it's important to find the authentic sweet spot between what your brand means to the consumers you serve and the impact that it can potentially have on the world. And that has to be authentic. You have to walk the talk, to really have actions behind what you say. And I think, you know, if you know, we certainly strive to follow that guidance, and that's the sort of guardrails we use internally on how to navigate. But yeah.
You've mentioned, just going back to something you mentioned earlier, Jane, on Gatorade. Gatorade has long been the standard bearer in that sports drink industry. It's a brand we've all grown up with, but there's been a lot of new entrants in this space. Body Armor, you name it. And they've taken some market share. Is it time to change the messaging for that brand? Or, I mean, how do you take into the next generation to take the fight back to some of these other smaller brands?
Yeah, look, Gatorade's one of our fastest growing parts of our portfolio. And ultimately, you know, we're going to stay distinctive to who we are and really focus on category growth as our primary driver, as well as being competitive in the market. And the way you do that, I believe, is you double down on your strengths. So, you know, Gatorade stands for hydration, obviously, and fueling access to sports. And what we're doing is we're really trying to deepen our impact by creating more choice. So you've seen innovation on Gatorade recently. Gatorade Light, obviously. We're innovating into new formats, such as reusable cups, powders, pods, you know, driving new occasions to drive plastics out, and really trying to innovate into spaces that actually our consumers really are asking for. We're leading and shaping the category by meeting our consumers' needs every day, and that's what we're focused on.
We only have 15 seconds, but can generative AI tell you what the next great flavor of Gatorade might be?
It's always blue. It's always blue.
Always.
Or is it red? No, it's blue.
I would predict that generative AI would say it's delicious. I'll leave it at that.
Jane,
that's blue.
With the mic drop moment, Jane Wakely, Chief Consumer Marketing Officer and Chief Growth Officer of International Foods, joining us here. Excellent. We'll toss things back over to you. Welcome back to Cannes Lions Festival of Creativity. Brad Smith, Brian Sazi, and now we're joined by the Chief Marketing Officer of Coca-Cola, Manolo Arroyo. Great to have you here.
Thank you. Thanks for the invite.
Absolutely. All right. Well, first, you've got the Coca-Cola in your hand. I mean, you're too cool for school right now. You're staying ice cold out here as we're seeing the sun start to open up a little bit more. You talk about the reach of the consumer base and the number of people that play into that marketing function as influencers too, whether direct or indirect. And one of those indirect ones has been Warren Buffett. You've also had indirect ones such as former presidents of the United States. So for better or worse, it's kind of going into a next or even amid a polarizing time right now where one influencer can be looked at or perceived differently than another. How does Coca-Cola manage its own brand perception despite who's talking about it?
I think the critical component is to have clarity of what you stand for. And it all starts by being extremely respectful to the heritage of what the brand has done in the past. This is one of the most, if not the most, inclusive brand in the planet. It stands for phenomenal human values such as optimism, happiness, freedom, peace. At the time in which the world needed peace, we claim, please, be in peace. And that got us to where we are. Now, if you stick into just the old territory, you won't be expanding the meaning that would make the relevance require so to trigger transition or conversion from non-consumers into consumers. And that's where you need to craft very carefully how you're going to go about it. We have identified a series of potential triggers of that conversion. For some humans are about consumption occasions. Why is that the case? While everyone understands that maybe why you should drink a Coke and what are the benefits as a product, a lot of times you don't understand where and when it's appropriate, you're missing the context. And that works for quite some people. An example of that is connecting Coca-Cola to meals, meals occasions. We're getting significant new incidents of new consumers coming into the franchise through association with meals. The second bucket is around passion points. We all have different passion points. And that's where topics like music, gaming, traveling, sports play a significant role in driving some of that conversion. For a portion of the population today, particularly Gen Z, in certain markets, ESG, your level of commitment on ESG, it matters. And for others, it's innovation. So we're playing with all of those different conversion drivers or factors that will ultimately allow us to accelerate what we're going after, which is basically growth. Right. The name of the game for us is growth.
This year, how much will you spend on marketing? How does that compare to next year? And then if this brand is in fact about optimism and peace, how are you thinking about your budget next year for election season when we might see an election that is anything but peaceful and optimistic?
Well, we don't disclose specifically our marketing budget, but as you can imagine, there's official sources out there, and you could think it's in the multi-billion-dollar magnitude. Now, bear in mind that one piece is what we invest in marketing, and then there's the other piece that is equally important, which is what our bottlers invest in marketing, which is a similar, roughly the same amount. So that gives you a tremendous marketing muscle. Factor in that not only the paid media, but what we define as owned media or earned media. And part of that is 30 million outlets, which we serve and we touch every single week of the year in every one of the countries that exist out there except 3. More than 10 million coolers in those 30 million outlets. Thousands and thousands of trucks that are moving, they're moving outdoor connection points that we're leveraging in our marketing. So the ecosystem of the engagement points that allow us to reach millions and millions of consumers is just phenomenal. Now, your question on the US. US represents, roughly speaking, I'm just going to round the number, around 15% of our business, and it's obviously from a marketing perspective, important and very critical because it's extremely visible. And it's a market that we see tremendous growth potential. We're seeing in the last couple of years very interesting dynamics, not only in Coca-Cola trademark, but across the whole portfolio. We're seeing explosive growth in Fairlife, in Sprite, in hydration. So it's really off to a great start in the US. Now, next year, it'll be a very important year. As it relates to public or political potential controversy and how we play there is very simple answer. We don't play in that.
But do you want to see an ad for Coke products next to stories, for example, on a digital property regarding the election? How do you handle that?
Obviously, from a brand safety standpoint, we have very, very clear guidelines. Very clear guidelines. We're going to stay away from any major controversy because there's a principle here. As I mentioned before, we are the most inclusive brand. This brand is for everyone. In our employees, we have not only our company employees, with our bottling employees, we reach close to 1 million employees around the world. So our diversity of opinions from a political, sexual preference, ideology, you name it, it's as wide and as big as the population in any given country, including the US. And we welcome everyone. We've always welcomed everyone. Now, we can't avoid that people have their own opinion, and that's got to be respectful. Our employees do as well. But when it comes to our marketing communications, we are taking a position of inclusion. That's what we stand for. It's a value that transcends, in our view, what's out there, and it's more important because ultimately, what we're saying is we're a simple beverage, we're just a soft drink, and don't expect too much of a soft drink. Who are we, right? So just enjoy it, have fun, and enjoy the pleasure of it.
Well, one thing that people are having increasingly more fun with is some of your canned cocktails right now. We've seen a couple of those being passed around here, especially as people are getting saucy at canned this year. When you think about how much you would like to allocate towards that part of your growing business in either marketing spend or just consumption as a metric that you're tracking, what does success look like?
You mean in our latest experiments in the portfolio?
Yes.
We've been experimenting over the last, we started 3 years ago, actually. October, September 2020, actually. And we are very, very happy with the results of those experiments. We're still in the in the process of learning how the category plays. We see clear potential. We still are shaping the line of sight of how that could become potentially and how big it could become for us in our portfolio. We still are in the process of having those discussions internally and basically firming up our investment and our plans for the future. But we see it as a promising category because that's where the consumer is going. Mm-hmm. And whether you like it or not, and this is maybe unknown, if you go to the archives of our archives in Coca-Cola, there are materials that associate not only Coca-Cola, but some of the other brands, Sprite, for example, to different beverage options in those consumption occasions. So it's not something new. We've been doing some of that since.
So Sprite had alcohol at one point?
Not in the product itself, but communicating. For example, we got 1960s communication materials of a Sprite with vodka. And obviously, Cuba Libre, rum and Coke. It's been part, as you may have heard, of our legacy for decades. At different points of time, the levels of activation only in the outlets and only in the trade where it sells and is authorized to sell that have been having had different degrees of execution depending on the country as well. But moving forward, we see, particularly maybe not in the whole world, but in certain markets, we see that the consumer is going there. The credentials and the credibility of our brands to play a role there, our rights to win, we define, are very clear.
Well, you'll be pleased to know that a rum and Coke is one of my go-to cocktails that is out there.
Why do you like it?
Why do I like it?
Yeah.
Well, because it's the Coke. It's
the Coke. It sets off the drink. It's great.
It's not because of the rum. It's because of the Coke.
It's because of the Coke.
That's the right answer.
Just say no comment.
My boss is listening. It's because of the Coke.
I love it.
Manolo Arroyo, who is the Chief Marketing Officer of Coca-Cola, joining us here at Cannes. We'll send it back to you. A hot topic here at Cannes Lions is the role of artificial intelligence in advertising and how that impacts our exposure to the brands we all know. We spoke to some of the biggest names in advertising and branding to discuss how AI and technology are changing the ad business.
You'll never know who you find at Cannes Lions. So I'm having a power lunch right now, a power lunch with Sir Martin Sorrell, S4 Capital Partners founder. Not many people get to have a power lunch with you, Sir Martin, so thank you for joining us. We appreciate it.
Well, we haven't had much of a lunch.
We had lunch, we have some coffee,
Jesus,
we have some water, you know.
I've had water and that's it.
All right, we'll get it after. We'll get it after this interview. So talk to us. You're a veteran of Cannes Lion events. What do you think of all the tech companies here?
Well, it's become a tech conference. And what do I think? I mean, look, you've got the 6 big platforms, the 3 Western and the 3 Eastern. So you've got Alphabet, you've got Meta, you've got Amazon, you've got Alibaba, Tencent, and TikTok, or ByteDance. Then you've got the smaller platforms like Twitter and Snap and Pinterest. And then, of course, you've got the Microsoft, Apple presence, because that, with AI in particular, is going to become, and the metaverse. I mean, you saw Apple's announcement around their new headwear. So I think that those are those 8 companies, plus Nvidia, obviously supplying the picks and shovels, and then I would add Salesforce and Adobe. I think that's where, and interestingly, because of the regulator trying to stop Microsoft on Activision, stopping Meta on Giphy, for no good reason. And the only reason could be that big is bad, right? There's no logical argument about cloud gaming or scale on Giphy. I mean, you could have solved that in a heartbeat. So with the regulator putting pressure on them, it means that those companies are going to become even more focused on organic growth. So their research budgets are huge.
Well, let's go back to Apple. Made a lot of headlines with these fancy looking glasses. Is that an opportunity for the ad industry? How does that change what this industry does?
It is.
How does it change media?
I would guess that companies like Apple are going to be coming out rapidly with announcements in the AI space, just as we've seen from Alphabet and Microsoft. I mean, Alphabet have been working on it since 2014. I mean, they're the father or mother of this. So I would wrap it around 3 things: blockchain, metaverse, and AI. And AI, or AGI, has already started to impact visualization and copywriting. That's one thing. Hyper-personalization at scale. So if we thought we could produce for Netflix, 1.5 million creative assets, we're going to be able to do multiples of that. The third area is media planning and buying. Why rely on a 25-year-old media planner or buyer when you can rely on an algorithm with us checking it? You wouldn't give your budget to Rupert Murdoch unsupervised. I mean, there's nothing against Rupert or that he would do anything wrong, but you want to have a validation. So we validate, we resell, if you like, and we watch and we monitor. So that's the third area. Use as a super tool for improving our own processes and client process. And then the thing I think, which is the most important thing, is knowledge sharing. So, the guy who resigned from Google because he thought the bots would be an existential threat, I think actually it's sort of the reverse. You can turn human beings into human bots because you can transfer knowledge with them. And as long as the data that you ingest into the platform is right, and over time it gets better and better. And as long as you open it up to everybody in your organization, so all our 9,000 people will have access, God willing, to all this information.
What's your economic outlook? I'm assuming you met with a ton of people. You always have a good pulse on this stuff.
It's tough. It's tough. I think 23, 24, in the presentation I did on Monday, I finished it off with 23, 24 is going to be tough. I mean, the stuff in the last few days around interest rates, what Powell said, what the Bank of England have done in the UK, it looks like, GDP will be lower than before. Interest rates, inflation will be higher. I mean, it's not going to go down to 2%. And interest rates will be higher for longer. So that has not bitten into the economy. I mean, it's quite interesting watching what's happening about mortgage rates in the UK. Consumers are now starting to complain bitterly about, as they refi their mortgages or renew their mortgages, about the increased cost. And they've never really focused on it. So they didn't have variable rate mortgages, they had fixed and they had to refi them. And that's starting to have a huge impact, I think, on consumer sentiment. So I would say, the chances of a recession, Goldman, I think, have it at 25%.
Yep.
But with GDP growth in the US around 1.7. The world's a different place. It's a much more fractious, fragmented place.
I've asked a lot of big CMOs, we've had a lot of CEOs on Yahoo this week, how they plan to advertise and approach and lead during what could be a very polarizing, another election next year. What is your sense of this? How are companies going to advertise? Are they going to pull back, you think, during next year?
The geographical fragmentation means you have to select your markets much more. So North and South America, the Middle East, and Asia, and I'm going to say not ex-China, but if you've got a big position in China, you're not going to go more because of the tension around Taiwan. If you have a small position, I think Unilever has 7% of its revenues in China, for example. So and it should be around 20% because China's 18 trillion out of 100 trillion GDP, and 2050 it'll be the biggest. So that's one thing. Europe, the runes are not so good. I mean, people are looking more from a cost base than cutting costs than revenue growth. So those will be the growth markets. So in Asia, it'll be India is the big gainer. Modi's in America, and playing both ends off against the middle, but doing the right thing by India, and I think that's growth. Indonesia, Vietnam, Thailand, the Philippines, Malaysia, Singapore. So that's the sort of geographical. On the technology side, because it's lower growth, and therefore the focus will be on quarterly growth, like-for-like growth, and margin, that's going to mean that the digital transformation is going to be accelerated. So I think what clients will be doing is there'll be more activation and performance, more lower funnel, what we call lower funnel work, less strategic work, very focused on results, very focused on performance, ROI, measurement, and then geographically they're going to be much more selective. It used to be, last 50 years, didn't matter where you went, if the demographics were with you, you did well. Now you're going to have to be much more selective. And so it's a very different world to the last 50 years.
We will leave it there. Sir Martin, you're always gracious with your time with Yahoo Finance. I will let you get back to your, meeting? How many meetings have you had?
Too many.
Too many. All right, we'll leave it there. Brian Sazi out.
What's going on, Yahoo Finance fam? Now, you already know me. You know I don't do boats. I don't do cruises. However, I'll do a yacht, especially if we get the invite from Gary Vaynerchuk here with us on Yahoo Finance. Thanks so much for taking some time.
Thank you for having me.
We're here at Cannes Lion Festival of Creativity.
Yes.
There's a lot of creative folks here, but you are among the creme de la creme out here in Cannes, France. When you think about so many of the conversations that are taking place, people would love to be a fly on the wall in the conversations that you're having out here. What is one of the themes that's sticking out to you, a through line in some of those conversations?
I think the thing that, especially this audience, which I think is very business-minded, would be fascinated is the advertising industry is incredibly detached from the actual business results. I think that the industry is very good at yesterday and tomorrow. So I'm sure what you have felt is yesterday and tomorrow. A lot of people want to talk about the creativity of the TVC ads, and then they want to talk about tomorrow. AI is being thrown around here all day, 24/7.
You think it's all hype?
No, I think AI is one of the most important things in the world right now, but I think the ad world, when they talk about AI, is not like the tech world. They're talking about it in a hyperbolized way without really understanding the tech. And so today's marketing world is being great at creative in social media. Social media is building brands, yet there's no talk of social media creative here. There's talk about television commercials that nobody watches, and there's talk about AI that's not fully here yet. And so I think that to sum it up, there's a really interesting thing happening here, which is the big opportunities for entrepreneurs and small businesses and private equity owned brands is the biggest brands in the world are missing the mark. And in that is the opportunity and the arbitrage for the competitors.
Which brands are doing it well?
What's hard about that is, the truth is that the answer is not too many. I will say that Chipotle, somebody that we don't work with, that I could see from the outside, that has made a huge commitment to social and culture, is doing a nice job. They stand out, but you know, from my filter, people that are allocating all their money to brand work that's not being seen, or programmatic digital banner ads that no one's consuming, it's hard for you to do it well. What Chipotle's done well is they've made an actual commitment to social media creative. I think Wendy's talking about a couple QSRs that, and think about those companies, they can see the results on the day.
Right.
They have stores.
Yeah.
And so DTC brands, QSRs, but some of these consumer packaged good brands, car brands, automotive, like these big brands, they continue to buy into Don Draper, and he's been dead for a long time.
Yeah. And so as you think about going forward from here, where brands are creating cultural relevance, because that's been one of the key talking points for many CMOs.
But they don't do
out
that,
here.
my man.
How are they missing the mark there then?
Let's break the fifth wall here, or whatever it's called. What brand drives culture? Maybe in their product.
Sure.
Right?
Yeah.
LVMH, Nike, you got brands that Apple, they bring, but in their ads?
Mm-hmm.
Tell me about the ad
Yeah.
that crushed culture. We had one with when Dwayne Wade retired. I don't know if you remember that.
Yes.
We did that Budweiser ad that everybody on earth saw. You can only break culture if you make videos that don't look like commercials.
Mm-hmm.
What commercial? Do you understand that they are spending the majority of their money on commercials and banner ads? Tell me right now, anyone watching, what commercial or banner ad broke culture?
Right.
They break culture through their products, a watch, a sneaker, that they can break culture. They break culture in the form of an activation occasionally. They like did it proper in F1 Miami, you know what I mean?
Yes.
Things like that, activations. But through their advertising,
right.
It's a joke. They don't break culture. We're not living in the, where's the beef? The just do it.
Right.
The Spike Lee and Michael Jordan commercial, that doesn't exist today.
It's got to be the shoes.
That doesn't exist today
Right.
because we don't watch television commercials. Yet this industry's infatuated with starting there because the agencies make a lot of money selling those.
Certainly. As you think about even going forward from now, we've been having a lot of discussion about if generative AI is having its cell phone type of moment as a multiplier on how we live our everyday lives. Do you see us hitting that anytime soon?
Yeah, I think that's going to happen. I mean, it's definitely going to hit. It's hit for entrepreneurs, solo creators, small businesses. For the big brands here, even though I have a lot of anxiety to the way they advertise, I'm empathetic that they haven't gone there yet because I think there's a lot of copyright and trademark issues on the generative creative hitting the world that I do think the biggest brands in the world are being thoughtful and thinking through properly. But yeah, it's going to allow for a lot of output.
You're a serial entrepreneur. You've started so many businesses or invested remotely or just counseled businesses in how to do better. What's your next big investment?
The truth is, I'm not sure, and I think that's my strength. I don't want to force the issue. Today, I said that I think social media creative and ads is like the way to go. But in 6 years, I might be like, are you crazy? Why aren't you doing this VR stuff? This is now overpriced. Television commercials were on point in 1979. In the same way of how I think about big investments, I'm not sure. Because don't forget, it's a combination of the entrepreneur and the space.
Right.
You know, yeah, I've been looking at AI startup for 3-4 years. But you have to find the right entrepreneur to go along with that. She or he has to show me the capacity of being able to adjust along the way.
Right.
There's a lot of variables to investing in the early stage the way I do, which may be a little bit different than some of the audience. So, but it's about staying curious and staying to the pulse of the actual pop culture and consumer that is very important for me. And so that's kind of where my mindset's at.
You know, I'm naturally looking at all of your investments that come through, and pickleball sticks out to me. That's one you made last year.
Yeah.
Pickleball is having an explosive moment right now. So next 5-10 years, is pickleball the sport that everybody is playing that has no skill at anything else? If some have said, if you don't have skill, play pickleball, but it still requires a lot of skill.
People saying no skill pickleball is like people saying like engineering, building websites wasn't important. Like, you know, like, oh, you're building websites? You mean the engineers of the internet that all made trillions of dollars at Apple and Facebook and Google? You need real skill to be a good pickleball player. Yeah. There's plenty of people who play basketball with bad skill to be one of the best basketball players in the world. So I think to the point of basketball, why it became so popular, because you could really play in a lot of places from inner city. You know, hockey's expensive.
That is. Golf
so
is expensive.
Golf is expensive. So there are millions of people who do not have the income levels to do that. Basketball became popular because we could all play. Yes. Even though the way some of us grew up in the dirt, right? Pickleball's gonna have that same phenomenon. It's so easy as a cost of entry to play. And that became another example of what I believe in. What I do is I pay attention. If you think that if we were doing this 3 years ago and you said, what's your next big investment? And I would have said pickleball, I would have laughed you out of the room. But I watch. I watch. And when I saw what was happening with how many people were playing and how much fun a 68-year-old grandma was having with her way more athletic 18-year-old grandson, and it was competitive, and the cost of entry, and then when I watched how people were consuming it on social and YouTube, and I watched that the Madison Square Garden numbers at midnight when they were airing it were way better than they should have been. I'm watching, I'm quantifying, and I'm looking at the qualitative data. I can't believe Twitter. I can't believe I like pickleball. I played pickleball for the first time. I love it. I'm gathering, and then I'm like, wait a minute, this has a chance. I'm not naive though. 99.9% of leagues fail. But I was like, this could be that. And obviously Major League Pickleball has had a real moment. It's really happening. And look, it's hard to become a predominant sport in culture, but pickleball is already, as a sport, further along than many things that have come along in the last 30 years that have died. Major League Pickleball's already further than the XFL.
Right.
And so it's happening.
You're plugged into so many business conversations, and I got to hustle till my finish here, but as we hear from some of the CEOs right now, they're all concerned with the reality of a possible recession this year. They're battening down the hatches, they're changing their spending. Is that something that you're hearing from them as well, and what are you advising?
This is why I'm so frustrated here. We can't waste money on dumb ads. We don't have the luxury of it anymore. My energy comes from the CEOs. I'm just trying to get the CMOs to understand why it's so hard to keep a job as a CMO. We need results. For the Yahoo finance crowd, this ad world plays in banana fake land. They have to get more serious about where brand is built, social. They need to measure actual business results, not fake reports or awards. We need a new world order in marketing. Otherwise, their budgets are going to continue to get cut because it's not working.
Gary, we appreciate the time here
Thank you,
today.
man.
Thanks for
Stay
inviting us aboard here. I'm going to try not to, maybe I'll go for a swim, who knows? Why not?
See you, everyone.
Thanks so much, guys.
And that's a wrap for Yahoo Finance's coverage at the Cannes Lions Festival of Creativity 2023. Brad, wow, what amazing series of deep conversations that I know investors will really help them grow their wealth and just kick major butt in all things investing.
I'm shooketh. I'm blown away. Fortunately, the wind didn't actually take us away, but these conversations blew us away for sure.
That's it for us.
Possible Fed rate hikes, worries over inflation, and an unpredictable housing market have dominated headlines in the first half of 2023. Despite all this, it's been a strong first half of the year for stocks. So where do things go from here? Yahoo Finance spoke to experts, including top strategists and economists, to find out where they think markets are headed in the second half of the year. Take a listen.
Fight the Fed, get clubbed over the head. And I think Tony was really on point. Will bring to light this economic slowdown we are in fact experiencing. So you take that economic slowdown and you have a Fed just about a week and a half ago, 2 weeks ago, telling investors, you know, a pause does not mean we're done raising rates. And as you go around Wall Street, you have a lot of folks, I think, now worried about 2 more rate hikes this year, not 1, 2. And that is a big change in sentiment and market expectations just compared to a month ago that sent all these AI stocks to records, set NVIDIA stock to over $1 trillion market cap. So there's been a change in sentiment. And I think the market is still trying to adjust to what the Fed may do in the back half of the year. And you can fight it at your own risk. But a lot of folks I'm not talking to in the street are now trying to get a little more defensive, position clients a little more defensively, dividend payers, safe balance sheet type companies. So rotating out of some of those riskier areas into more safe haven plays.
I mean, Tony, it feels to me not like the Fed changed its message, but that the market finally just started listening to what the Fed was saying. I mean, all these people pricing in a hike before the end of the year, that was not the message that the Fed was ever putting out there.
Yeah, to Brian's point, you know, a lot of folks are now starting to talk about the defensive behavior that we've been anticipating that's really actually taking place in the average stock. The thing that blows me away, Julie, is that people keep referring to what the market is saying, even though the market has been dead wrong on what the Fed is going to do over the course of the last year. Like I look back at the middle part of last year, and the Fed funds future peak rate was expected to be 3.25%. So the idea that we're going to look at what the market's expecting and somehow extrapolate what the Fed's going to do kind of is bananas. So to me, when I look at what are the market, the optimism in the market is surrounding this rolling recession or soft landing environment. So what I did is I looked back at the 2 prior soft landings that we've had, which were 1966 and 1995. And it's not like it just came from magic. Those soft landings were generated because there was an amazingly fast drop in interest rates and short-term interest rates that created a steepness in the yield curve that increased the outlook for money. In other words, by making it more profitable for institutions to be lending. We're not obvious, to Brian's point, we're not seeing that. We've seen this elevated level of short-term interest rates. So the catalyst for a real market rally or a soft landing comes from short-term interest rates because it improves the outlook for money. And that is obviously not present today. We're 126 basis points on short-term interest rates higher than we were from the October low of last year. And that's just so different than what happened in any prior soft landing or soft landing market recovery.
Tony, it feels like the market is it's hanging tough because the fourth quarter by this year, you might see a real acceleration in earnings growth. S&P 500 earnings maybe grow between 8 and 9%. But if we do in fact get 2 more rate hikes, is this just a market that is just clinging to too much hope about corporate earnings power?
Brian, I really go back to, you know, there has been a little bit of broadening, but what market are we talking about? You've got more than half of the S&P sectors that are down for the year. The Dow Jones Industrial Average is only up 1.75%. The Russell 2000 small and mid cap indices are up small single digits. So it's not been a robust year. And I think that's the challenge for folks like us to talk about is we're gauged by the S&P 500. That's the major market that, okay, is it a good year or a bad year? But that's really that based on those mega cap tech stocks, which dominate the Nasdaq Composite and NDX as well. Those are really the ones that are up. So you've got this extraordinary movement in those stocks. And, you know, the debate becomes, will that mean that the broad market plays catch up? Again, Brian, I go back to what happens with short-term interest rates. Like I'm typically kind of known as the permabull and the guy that's the most optimistic. And it's no fun being cautious, but there's a reason for that. You should be a permabull when the money's widely available and growing because it's a leveraged system. And to me, I've always been really bearish when the money is shrinking and the outlook for money is not improving because that's what creates that ultimate earnings decline, which ultimately I believe is going to come.
The inflation data is really getting graded on a curve, and it's an easy curve because the year-over-year comparison is now comparing against the spring and summer of 2022 when energy prices were surging after Russia invaded Ukraine. So something would have to go really, really wrong for inflation not to slow in the month of May in this release. I think the bigger question is going to be what happens to sticky service prices. And the Fed has said that they are concerned that those sticky service prices, that's the cost of getting a haircut, the cost of sending your kids to daycare or getting your car repaired, those are not slowing as much as energy prices or food prices. And the Fed wants to see the overall economy cooler so that we see less pricing pressure, less pricing power from businesses and less pricing pressure from wages, bringing overall inflation lower, not just this year, but next year as well.
Bill, the housing market has held up strong recently, and we have more housing data coming in this week, new home sales, et cetera. Are you expecting the housing market to remain resilient?
I think the housing market's going to be resilient in the second half of this year. And I think there's a good chance that the bottom, both for residential construction as well as the bottom for new home sales, is in. There is a big drag on home buying power from high mortgage rates at this point. But high mortgage rates also mean that a lot of people who might have downsized, might have moved, might have sold in 2023 are holding on to their 2 3/4% mortgage and are not putting that home on the market. And that means there's just much less supply of existing homes. And that is funneling new home buyers or funneling home buyers into the newly built segment and really supporting construction and transactions in that part of the housing market.
Does that also imply, Bill, that once rates stop going up or even start to go down, that we will see more of a lift to the housing market than we would have traditionally?
Another way of thinking about it is that the Fed is going to be more reluctant to cut interest rates given how resilient housing has been. And so while I think that the Fed's next decision, probably a 1/4 percentage point hike in July, I'd say better than 50-50 that that's the last hike of this cycle. But I'm now thinking that the Fed will probably go quite slowly in 2024 in reducing interest rates. Right now, I have rate cuts penciled in only quarterly next year, so still leaving short-term rates at a relatively high level at the end of 2024. And that's different from what I was thinking 3 months ago when I thought housing was going to be more of a headwind to the economy and that headwind would last longer.
So, Bill, what other differences have changed in your view on the economic picture? From your view, are we headed to a recession still this year?
You know, I have that recession in my forecast. It's for economic forecasters, we're kind of in the extraordinary claims require extraordinary evidence at this point. And with the yield curve so inverted, you kind of have to have the extraordinary evidence that the economy wouldn't have a recession. The Fed's own, the New York Fed's forecasting model based on the yield curve has a 70% odds of a recession over the next 12 months. So to say that, you know, the other 30% is going to come through, you need to point to something really remarkable going on in the economy now, keeping it out of recession. There are some good things happening, though. In addition to housing, you've got consumer incomes, household incomes outpacing inflation since June of last year. And the labor market in general is remarkably resilient. Labor force participation of workers under the age of 55 is at the highest in over a decade. So that side of the economy is holding up quite well. It's possible we'll dodge a recession. I think right now the central case is probably a mild pullback in activity, and we can argue over it for months and months once the data come in, whether it was just a soft patch or an actual mild recession. But I think the odds of a more serious recession seem lower than they did 6 months ago.
So break this down for us, because we could be, as you said, perhaps getting a breather, or perhaps this bull run might be due for a breather. What would that look like?
Yeah, I think it's just a case of a little bit too much too fast for this bull market. We've had a great run off the October 2022 lows, officially acknowledge those as the bear market lows. I think there's overwhelming technical evidence that supports we're in a bull market, and not just that 20% qualifier. Off those lows, we're in an uptrend. The moving averages confirm that. Momentum confirms that. But speaking of momentum, we're looking a little bit overbought here in June, and that's really where our call is that we're going to see a breather here for this relatively new bull market. Part of that call is based on the technology sector. That's really where we're seeing overbought conditions broad-based. And if you think about technology, that's really been the main driver of this year's rally. If you strip out the tech sector, the S&P 500 is up about 5% year to date. So there's some pretty big shoes to fill for other sectors if we get a pause in technology. If you look at the technical setup for the technology sector, it's well extended above its moving average, actually hit a 13% premium above its 50-day moving average. Now, that's a 2 standard deviation move. We like to look at that as kind of a rubber band. As it gets stretched too far, you often get at least a pause or a potential pullback. So we think that could spill over into the S&P 500. Now, to end on a good note, the positive sign when you get a mean reversion in a bull market, you usually come back to the longer term uptrend, the S&P 500. We think worst case scenario, that could be right around the 200-day moving average.
So we're going to break some of that down, because as you mentioned there, if we do have this breather, then which are some of the sectors you think are really primed to try and at least fill some of those shoes if tech it does start to pull back a little bit?
Yeah, so we really like the industrial sector. Technically, it looks constructive, and thematically, when you look technically, we'll start there. It recently bounced off its 200-day moving average, broke out of this consolidation range that it's been stuck in for most of the year. So it hasn't really participated in this rally except for the last few weeks. So we're seeing the sector broaden out, get back toward record high territory, and also relative strength. When you compare it to the S&P 500, that's actually reasserting itself into an uptrend. And again, breadth is expanding there. We're seeing a lot of new 52-week highs within that industrial sector. Big part of that, I think, is going to be this reshoring theme that we continue to hear about, especially among CEOs. It was actually one of the most mentioned, the reshoring tagline was one of the most mentioned things in the Q1 earnings call, even more than AI, according to some reports. So I think that fund flows will continue to move into the industrial sector. From a valuation standpoint, it looks relatively cheap relative to its own history. So we continue to like that on the as a potential area where capital could flow out of tech and into the industrial sector.
So let's talk inflection points here, because you noted the cumulative S&P 500 advanced decline. You're saying that that's at an important inflection point. Break that down for us and what historically has tended to happen when we see this.
Yeah, so the advanced decline line, or the cumulative advanced decline line for the S&P 500, simply just measures the number of advancing stocks versus the number of declining stocks. When it's moving higher, that means there's more advancers than decliners. And we like to use this as a measure of market breadth to confirm or deviate from an actual breakout point. And that advanced decline line is basically stalled right at the August highs. So we're waiting for confirmation there to see if it breaks out. That would give additional validation to the S&P 500's breakout above 4,300. We have not seen that inflection point yet, so we're potentially seeing a divergence here with the S&P 500 moving higher and that advanced decline line failing to confirm that recent breakout.
And of course, we have a number of factors at play. You have a lot of people pouring in because of this AI fervor, but you also have the Fed, at least in pause or skip mode, still expecting 2 more rate hikes by the end of the year. So then when you factor in the fact that markets are essentially either ignoring it or looking past some of those warnings from the Fed, how do you position your portfolio?
Yeah, so we're actually overweight toward fixed income right now and an up in quality approach. We think it's time for investors to lock in some of these high yields, especially how inverted the yield curve is right now. You know, you can get money market funds that are 5%, but there's reinvestment risk there. So we're actually recommending shorter duration, high quality corporates, locking in some of those rates right now for our clients.
For more on what to expect in the second half of the year, we're joined by Anna Han, Wells Fargo Securities equity strategist, and Jonathan Boyer, the Boyer Value Group president. Guys, thanks so much for being here. Jonathan, I'm going to start with you and the resilience that we have seen in the market thus far, last week's dip notwithstanding. What happens now?
That's a great question. And, I guess you have to take a step back. In the beginning of the year, no one would have ever predicted that the S&P would be where it is now, as well as the QQQ. So it's pretty hard to make these types of predictions. But the one thing I would say is this is a classic example of why you have to stay fully invested, because you never know when the market will go up and will go down. It's better to take kind of a long-term approach. But if history is any guide, if you have a strong first half of the year, the second half of the year is also strong. That's going back to data from 1945, and this really shouldn't be much of a surprise either. If you look back historically, the third year of a presidential cycle is typically quite strong. No strategist going into the year would have expected this, but if you look back at history, it shouldn't have been unexpected.
But I guess the anomaly here is that we have never had a Fed that's been in a rate cycle pattern or rate hiking pattern at this point in the cycle like we've seen right now. And Anna, I guess from your perspective as well, does that mean even if the S&P 500, because to Jonathan's point, we've seen that move higher by about 13% year to date, does that mean that the rally is still on into the second half?
It's possible that the rally still has some legs. And you bring up a great point, Jonathan, that, it's Fed path driven here. But something we keep in mind is what is really leading this market? Where's the concentration? And the lack of breadth is something we've had a lot of conversations on. So even if you say to be exposed to the market, really it becomes what part of the market do we want in our portfolios? And also, how much more can this AI-driven fever go? You look at really, it's been the top 10 names, maybe even 8 names in the S&P 500 that has led this rally. Even if the Fed decides to go another 25 basis points, which is what we expect in July, perhaps even 50 basis points is on the table for the rest of this year. It's very possible that that's not enough to really cool the market unless we really see something break the consumer. And so far, we're not seeing big signs of that in the data.
So putting all that together, and it sounds like you think that we could still see stocks continue to move higher from here.
I think it's possible. At the same time, something that we have noticed is because people are expecting the Fed to cut, though we don't think that it's going to happen that quickly, the expectation of yields probably coming lower in those Fed cuts have helped bring out a little bit of risk appetite. Now, risk appetite has been expressed also in a little bit of a rotation that we've seen into more small cap space. So if we see that rotation gain some momentum, we might see large cap stall out, move sideways. We might see a little bit more life breathe into the small cap, mid cap space. So that's one possibility, and that's what we're looking for.
Do you also think 50 basis points through the end of this year? BIPs? I just love using the word BIPs sometimes.
Yeah, it's a nice word to use. I really can't comment on that. Who knows what the Fed is going to do? What they say and what they do has been very different if you look back over the last year or two. But to Anna's point, I think the best area to be in is in small caps right now. It's by far the cheapest area of the market. If you look back over the past 5 years, the Russell 2000 has basically done nothing, which is, and it's underperformed larger caps by about 7% per year. You look at the S&P 500 equal weight, which has more of the smaller names in there. It's down. It's up only about 4% this year. So that's the area where there's opportunity, as opposed to these large cap names that, for the most part, are pretty overextended.
Well, opportunity is all well and good, but something has to change in order for in other words, that underperformance could continue unless something changes. What would change to catalyze those small caps, for example, Jonathan?
Well, it's valuation, but to your point, valuations have been cheap for a long time.
Valuation alone isn't usually a catalyst, right?
It's hard to tell what the catalyst will be. No one would have thought there would have been a banking crisis in March. So it's hard to tell. So if the best prediction of future returns is valuation. So if you can just stand the pain and not have the try and go for instant gratification, I think people over the next 5 years will be very happy that they invest in kind of smaller cap names. And I think it pays to be selective because, especially in those areas, not all names are created equal.
And Anna, small caps right now, or do you remain defensive? Where are you kind of overweight or saying that there should be the most focus in an investor's portfolio right now?
Well, we haven't actually been that defensive in our portfolio, at least not in the traditional sense. We came in the year long, media and entertainment. And while we did ask investors to trim the volatility in their portfolios and be conscious of having some low vol exposure, or at least avoiding high vol exposure, we weren't looking to be in the Utes or REITs or staples space. And something that Jonathan mentioned is you have to be selective down the cap. We know it's a riskier play, but something that might change as well, in addition to valuations and traditional fundamentals, look at the technicals of how much the Uber caps, or you can use as a proxy, the Russell Top 50, have outperformed the basic broader market or the S&P 500. When you look at how that's done over a 5-6 year basis, you've seen that it's hitting its technically overbought levels. And that is also another signal to add on to Jonathan's point about valuation, why maybe it's time that small caps can have its chance in the sun here, or at least that we see a little bit of losing steam in this fever of these very concentrated biggest names leading the market.
The dynamics here, given what's happening with mortgages, are really interesting, sort of between the new home sales market and the existing home sales market. What stands out to you?
Right. Well, it's very interesting because I think a lot of people in the home finance space have kind of accepted that, they're about 2/3 of borrowers have locked in rates that are 4% or below, right? So those people who are already in homes are really not going to have an incentive to list anytime soon, because then they'll be shopping for a home at a much higher rate. And with the Fed signaling that they will, most people are guessing that they will continue to raise rates in the near future, there's kind of this acceptance that they will kind of creep up continually for the rest of the year. So with those existing homes just kind of staying locked with those homeowners, we're really turning to new construction and new homes, new inventory. Home builders are feeling great right now because that's where the interest is, the new inventory that's coming onto the market. And certainly we saw mortgage applications for new homes up 16% from last year and 8% from April to May. So there's really a surge in new inventory. People are very optimistic about what's coming onto the market.
And so for the new home producers that we've been tracking as well in the equity markets, I mean, is this kind of a broad-based production, if you will, recovery versus some of what they had been facing in materials issues, prices even of lumber, as we've started to see that moderate a little bit more?
Right. What I've heard is that it's a lot of catching up from backlogs of COVID with those constraints that they experienced then. So there is a bit of a little bit extra coming on because they're just really catching up to where they were so far behind before. I think there's also a really interesting push for manufactured housing at this point. Certainly, there was a report from Zillow last week that said, we need another 4.3 million homes to meet the demand. And that's including people who are really priced out of this market but would want to buy a home that was more affordable. And a lot of people at the governmental level and certainly in the private sector are saying manufactured homes could be the solution for that.
What does the graph usually look like between mortgage rates and home prices, right? Does there tend to be an inverse relationship, as rates go up, do prices come down? And is that happening to the same degree this time around?
Yes, I think there is a bit that does happen because, the sellers who really want to sell are motivated to make it a little bit more attractive to those borrowers who are reticent to sign up for a 7% interest rate. A lot of people in the mortgage industry say marry the house and date the rate, and they try to encourage the home buyers to, just get in now and then refinance in 2 years. We've heard predictions from the Mortgage Bankers Association that rates could get down to 4.9% by the end of 2024. So that could be, that's kind of good. That might entice some people.
It also feels like we have seen an explosion in the mortgage brokerage industry, or at least consolidation, right? Like we cover some of the publicly traded companies that are the mortgage brokers. Has that been better for home buyers? How has that affected the experience? Is it possible, even in this environment, to really find competitive rates?
Yes. I think cyclically, when rates go up like this, many LOs tend to then become brokers. They move over.
LOs, loan officers.
Sorry, pardon me. Yes. They become brokers. So they go out on their own and they're trying to source loans to really get homeowners or potential borrowers the best deal possible. So it's good for them because they're really working as an advocate for the borrower to get the best deal possible. And certainly those offering wholesale loans are really trying to stay competitive and keep their volumes up. And so they're incentivized to try to make a good deal.
If it's a recession, it's going to be a different kind of one. And I think most likely the economy will slow pretty markedly in the second half of this year into next year. That doesn't matter for what the Fed's going to do at its next meeting in July. They're going to raise rates a quarter point because they pretty much told us they'll do that. They have projected that they'll increase in total a half point by the end of the year. But that second step is a little more doubtful, exactly because the concerns about the economy are going to start mounting.
So does that just mean a cut is off the table anytime soon, even for those who have kind of bucked the trend out there and economists that have said, we could potentially see one if things get dire enough or if they get worse enough to the point where the Fed has to acknowledge it?
You can talk about cut, but you also have to add in the fullness of time. They're pretty clear that nobody on the policy setting committee expects rates to be cut in 2023. The recession dynamics we're talking about happen quickly, but it's not this weekend. It's going to take a little bit to evolve, and it's going to take a while for the Fed to recognize it. And meanwhile, inflation is stubborn. It will be above the Fed's goal still, and they're going to have some hard policy choices. So in fact, what the FOMC has accomplished in the last meeting cycle is mostly convince investors that the funds rate is going to a plateau in 2023, and it's going to stay at that plateau. No rate cuts this year. Whether that plateau is a quarter point higher from here or a half point higher from here is subject to more debate.
Has the Fed done a good job in communicating that message? I think about Christine Lagarde, the ECB president, who spoke today, pretty universally seen as a fairly hawkish message, a clear hawkish message. Does Jay Powell need to take some lessons from Lagarde, or do you think he's been clear enough?
So I think Chair Powell has a committee that he's got to corral into the policy decision. That's one problem. I kind of think he's a reluctant warrior. That he, among the members of the FOMC, are the one of the ones least inclined to tighten much more because he thinks there's credit constraint coming down the pike. Last meeting was a modest policy mistake wrapped in a communication error. The communication error is they didn't give a good rationale for pause. You saw it in the press conference. They said they're awaiting more information to make a better informed decision. That's why they didn't raise rates in June. But they also raised their forecast a half point for where the funds rate will be within 6 months. Explain to me how you could get enough information to revise your forecast up a half point, but it isn't enough information to make you want to change the current policy rate. That's where they didn't do a good job communicating.
Yeah, and Powell kind of downplayed the forecast, right? That I heard one commentator actually call it a horoscope. So I guess people suggesting people should take it with a grain of salt. It's ironic, Vincent, you say that the Fed chair didn't do a good job of communicating the rationale for a pause, if in fact you think he's really the one who wanted that pause, right? Or even would want the FOMC to be done. Why do you think he's not getting the message out better?
So the most time-honored technique for a chair to put off their committee is to say, hey, we'll know a lot more in 6 to 8 weeks. And that's exactly what Chair Powell did. I think when you listen to some of his answers and testimonies when he was up on the Capitol Hill delivering the semi-annual testimony, he's waiting to see credit constriction. We had bank runs in March. We were really worried that this was going to turn into a systemic problem. It didn't thus far, but those sorts of sudden withdrawals from banks, according to Powell, should be associated with a constriction on credit, 6 or 9 months later. We're coming into that window. He wants to see some evidence that maybe the quantity channel of policy constraint is kicking in a way that the price channel, what happened to the rate, has done so less.
Goldman Sachs says stock returns will be, quote, fat and flat thanks to rising rates. So where are we really headed and what does it mean for your portfolio? Well, thankfully, Yahoo Finance's Jared Blicker is here to break down some of that info. Hey, Jared.
Hey there, fat and flat. I like that line by Goldman Sachs. They're thinking higher for longer with respect to the Federal Reserve. And so what does that mean? It means that stocks are valued too high right now. They can't justify jumping in long now. What do they need? They need to see either rate cuts or long-term earnings increase in the forecast thereof. However, once you start pricing in rate cuts, guess what? That means recession, because why would the Fed cut rates unless they're worried about recession? And so that's the circle we're operating in right now. As you said, Rochelle, all indices in the green right there. I just want to focus on the sector action. It's been pretty instructive, not only today, but over the last month. Today, we got communication services and discretionary materials all up about 1%. Over the last month, I've been talking about the rotation that we've seen into some other tech, into some other sectors besides tech, besides the mega caps, and that's indeed what we've seen. Consumer discretionary, that's XLY, that's up 8.5%, followed by industrials, materials, and real estate. And just getting back for a second to some of these Wall Street notes, also Morgan Stanley out. They're expecting a hike in July. Now, that is not their baseline. That was not their base forecast a month ago. They thought it was going to be, we're over right now. That was as of the last FOMC meeting. However, they're saying that the Fed's hawkish tone, especially with Jerome Powell in front of the Senate and Congress last week, that kind of upped the ante a little bit on the hawkish stuff. And they're expecting, outside of very, very dovish reports from the payrolls that we're going to get and also CPI, outside of that, they think that the Fed hikes. So if we get a payroll below 100,000, or if we get a CPI print that's on a monthly basis above 0.2%, then they think that the Fed will have the reasons to pause. But just getting back to the earlier discussion of what happens when the Fed pauses, I just want to go back to the global financial crisis really quickly, because there's a very instructive example here. And in the meantime, I'm just going to pull up the VIX because I've been curious about that lately. But in 2004, the Fed had left rates at 1%, the very low for the time, and they started raising them. That was Ben Bernanke. He raised them into 2005, into 2006. In 2006, he paused for 12 months. Guess what? Stocks were making record highs that entire time. You contrast that with this cycle. We were in a bear market before the Fed even started hiking. So that's how quickly things are going right now. And it wasn't until the Fed actually cut rates in October of 2007 or thereabouts that we actually saw stock market finally decline. And that was the beginning of a huge bear market. Why? Because back to my original point, once you start pricing in rate cuts, that is an admission that you're going to get recession. So this whole thing is kind of, we're in a circular feedback loop right now. And some of it's defying expectations, defying reality, but eventually all these things come back to earth and valuations normalize and there's a return to the mean.
I think the big kind of catalyst for this, and obviously everybody would point to this, was the release of OpenAI's ChatGPT in November 2022. That kind of set off a cascade of events ranging from the general public becoming aware of generative AI, really I think for the first time for a lot of people, to companies scrambling to get their own generative AI products out. Now, that's not to say that generative AI was invented by OpenAI. The transformer technology behind this was actually invented by Alphabet, which owns Google. They fell behind, though, when it comes to the public perception of AI. And so, as they saw ChatGPT moving forward and OpenAI moving forward with that technology, they were in the background working on their own tools. So we had ChatGPT released in November 2022. In February, we saw Microsoft announce its new Bing and Edge browser. Bing is obviously its search engine as well as chatbot. That was preceded a day by Google launching its own Bard chatbot. It didn't actually launch it. It just kind of said, hey, we're working on it, and we'll talk about releasing it later. They just kind of wanted to kind of, throw some water on Microsoft there. And then we continue to see this steady cadence of companies releasing or announcing or discussing the ways that they're working with generative AI, whether that was Meta or Amazon talking about getting into the space, adding it to different features. Microsoft continued and Alphabet continued to talk about adding it to their different offerings, whether that's the consumer side or enterprise side. And obviously the chip companies, as a result, started to jump on that as well. So as of yesterday, we had NVIDIA up 176% year to date. And then we also have other AI companies, the C3 AI, it's an AI enterprise company, that's up 190% year to date. So obviously this is a kind of AI boom. We have companies like, as I said, Microsoft, they're up 37% year to date. They're kind of, angling to take over the search space and also just kind of be the big AI player. And then we have Google up 34% year to date. These numbers are all as of yesterday on the news of its kind of plays in AI. And, outside of NVIDIA on the chip side of things, we also have AMD, which is also jumping into the space or playing more in the space. They're up 69% for the first half of the year. So a lot of these companies really talking about how they're going to use generative AI or how they're working to benefit the space and the players in that space. And it seems as though we've had the discussion of the benefits and the negatives, those of misinformation, disinformation, people talking about copyright works being used to train these models, just nonstop since the start of the year. And really, I think if you can talk about one big theme for 2023 so far, we're just about the 7 months in, it has to be AI.
So Brad, I want to get your big takeaways from these numbers, the month over month and the yearly view, to really give us a sense of where we are right now in terms of the housing market.
Yeah, so we had a substantial slowdown in new home sales, and now they've been rallying for several months here. Now we've seen a really big jump that kind of corresponds with some of the activity that we've seen in housing starts in general. The last housing starts print was very, very strong, to the point that many people think it may even be revised down. But it was strong in particular, not only because multifamily new starts were still strong, that's to say structures with 5 units or more, but because single family starts had really jumped. And again, we're seeing this in the new home sales figures as well. We're also seeing a return of some strength, or at least a very clear bottoming in at least the month-to-month pricing in the housing market, as represented by the Case-Shiller index as well. So it appeared to me that after about a year and a half, or really a year of some kind of slowdown in general in housing activity and disinflation in home prices, that we're now seeing a floor and then a potential rally.
And I know a lot of people have been waiting for the single-family home market to catch up with the multi-family market there. But talk about the supply of homes, because we did see the supply of homes available fell 0.9%, down 2.9% from last year. So what are we seeing here? At what point are we going to see this level out more?
Yeah, we're certainly seeing, homes listed for sale, right, have come down. But at the same time, we've got a lot of housing under construction. The new housing starts data would tell us that we now have, it's increasing again, close to 1.7 million housing units under construction. That's enough to rebuild every house, every home in Connecticut, and then half of Wyoming. There's a lot of housing under construction today. So we don't really need to look at the existing home sales, the existing houses that are being listed. We can really just see that there's a lot of new product in pipeline, and we're already seeing this start to clear in the increased new home sales.
And as we're in this pausing phase for the Federal Reserve here, then what is that going to do in terms of interest rates and people thinking, is now still a good time to buy? Should I wait and perhaps then refinance if I do buy now?
Yeah, I think that's a question a lot of consumers are asking themselves. It really depends on what's going to happen at the long end of the curve. Our own analysis right now would say that because the Federal Reserve is still engaged in QT, that's to say that it's shrinking its balance sheet, and that some of that shrinkage is coming from the mortgage-backed security space. Not only is the 10-year artificially high, arguably, but even the mortgage spread is pretty wide. So right now, I think people could look to at least the potential benefit that at some point these long-term interest rates might come in a little bit so that they might refinance. But certainly it's a challenge for anybody trying to buy a home today if they have to be using leverage.
And do you think we're at the end of the hiking stage for the Fed?
Yeah, we do. We think, again, the market indicates there could be a possibility of another hike here or there. But I think it's quite clear that if anything, they're more likely to end up cutting over the next year than continuing a bold hiking pattern. My own view would be that continued disinflation just in the CPI index, that's again to say that inflation itself is cooling, could give room for the Fed to create a policy rate that corresponds with the lower inflation rate without us necessarily going into a recession. That's another way of saying we could see rate cuts without us going into a recession.
What will happen when consumers do run out of their pandemic savings?
Most of that money has been spent as the savings rate has dropped from an average of around 9% before the pandemic to around 3% in the final quarter of 2022. Many households still have more cash on hand now than they normally would want, but how much of that will they spend as the economy slows? One possibility is that many consumers will remain cautious and hold on to those savings even as they are able to go out and spend. Another possibility is that spending booms for a while longer as post-pandemic revenge spending on travel and consumer services continues to grow. Deloitte analysts forecast continued job and income growth will support sustained growth in consumer spending, but spending will slow as the savings rate eventually rises back to the 6% range. While spending on services has continued to gradually expand, spending on goods has been volatile. Recent PMI data suggests that the services sector is beginning to cool. The Conference Board expects high interest rates to further dampen spending on goods and forecasts that overall consumer spending will grow in the second quarter of 2023, but anticipate a contraction in the second half of 2023. During economic downturns or recessions, in this case, a recession that has yet to materialize, consumer staples tend to perform relatively well because they are essential products and would be considered defensive investments. That said, consumers may be more sensitive to further price hikes than they were to the past price hikes that took place in 2022, particularly if the economy softens further and the unemployment rate rises. Those best positioned for this backdrop may include companies that can raise prices further without losing sales volumes. Analysts at Fidelity point out two bright spots. Consumer staples companies with exposure to emerging markets could also be well positioned to weather any further economic storms in 2023. Many of these countries have a fast-growing middle class, leading to higher per capita growth in developed markets. Plus, many emerging market nations have been battling inflation for decades, which means consumers are used to seeing prices rise and less likely to change their purchasing decisions in reaction to price hikes. Finally, consumer staples companies that make private label products may hold up well as their lower price points attract consumers.
And Jill, we've really seen the tech stocks rallying this year and sort of lifting the rest of the S&P with it, but with the tech-heavy Nasdaq Composite up about 28% year to date. So what can we expect from the sector later this year?
Yeah, I mean, it certainly has been quite a year for the Nasdaq 100 in particular, which doesn't have financial exposure, which is why we tend to see it go a little bit higher than the composite. Virtually every company in every industry is now looking to use technology to get closer to its customers, innovate more quickly, and operate more efficiently. Many firms are embarking on multi-year digital transformation projects, and this may only accelerate as companies adapt to hybrid work environments. Companies that provide the technology to aid in these transitions could be potential beneficiaries of this trend. That includes the cloud, generative AI, and ML. Increasing adoption of cloud computing continues to be disruptive influence as enterprises shed their in-house hardware-based architecture in favor of cloud-based systems. And because of these hybrid environments and adding additional layers to the tech stack, the case for cybersecurity spend can certainly be made, and why the CISO, known as the Chief Information Security Officer, is increasingly finding a seat at the table of the board to bridge the gap between security needs and finances. In fact, your CISOs are reporting it to the CFOs at this point. Gartner predicts that by 2025, lack of talent or human failure will be responsible for over half of significant cyber incidents, and the consumerization of AI-enabled fraud will fundamentally change enterprise attack surface, driving more outsourcing of enterprise trust and focus on security education and awareness. Microsoft, the biggest investor in OpenAI, has launched Security Copilot. Copilot's AI assistant helps cybersecurity professionals use prompts to make sense of threat intelligence and investigative incidents. Palo Alto Networks leverages threat detection logs in its AI-based security operations center platform. CrowdStrike has equipped its Falcon platform with AI capabilities. There are also a number of cybersecurity startups in this space. Global cyber spend is expected to reach $219 billion in 2023 and grow to nearly $300 billion in 2026, according to IDC. Software, the fastest growing segment, will capture 47% of all cybersecurity spending this year, followed by services at 39% and hardware at 13%. And of course, this is according to IDC's forecast.
And of course, all this generative AI really sort of kicked off with OpenAI and Sam Altman there. And according to sources at The Information, they might be planning to turn ChatGPT into its own co-pilot, essentially potentially being a rival for Microsoft and some of these companies that thought they were going to just benefit from ChatGPT. How do you think that might change the mix?
You know, it's interesting when it comes to ChatGPT, because companies are leveraging it in different ways that fits their needs based on, you know, client profiles and what they're trying to do with it at the end of the day, right? So it's about all the input that goes in and how they're leveraging the output that comes out. So a technology company might use ChatGPT in a certain way, or whatever generative AI platform they decide to leverage, versus an industrial company, manufacturing company, healthcare company. They have different needs for different types of clients.
I want to bring in David Lebovitz. He's JP Morgan Asset Management Market Insights Managing Director. David, it's great to see you. So certainly investors had their fair share of news and headlines to digest during the first 6 months. How does this set us up for the second half of the year? What should we expect?
So I think that there are a couple of things that investors are going to be focusing on in the second half. Obviously, inflation and Fed policy are very much at the forefront of their considerations. But I think lingering in the background today, and something that will really come to the forefront over the course of the next few months, is the question of recession. You know, clearly we've started out this year better than expected from an activity standpoint. Some of that has to do with, the fact that Europe avoided a recession. Some of it has to do with the fact that China reopened. Some of it has to do with the fact that the labor market remains very tight. But we are beginning to see signals that some of those things are beginning to cool off and fade. The backup in initial jobless claims, the backup in the unemployment rate, anecdotally, consumers using their credit cards more, saving less. And so I think we're going to learn a lot about the growth story that, to the point that was just made, equity investors have very much been willing to look through. I think that's going to be the main focus during the second half.
So when you think about the potential for that recession, how much downside do you think investors should be looking at right now? Sure, that cloud has been lingering for some time, but it's been a question of how severe it's going to be when it comes.
So I think that the recession question and the market question are arguably two different ones. We do think that any recession, if it were to materialize today, would look relatively average. And that's not to say that we wouldn't feel it, that the unemployment rate wouldn't back up, that we wouldn't see a broader deterioration in the 6 variables that the NBER uses to evaluate whether or not a recession has occurred. But a lot of our clients seem to be suffering from recency bias and focusing on 08 or 2020 as kind of what they expect if we were to have a recession. And we think, again, it'll look more like what we've seen over the past 70 years on average, as opposed to what we've seen the past 2 times around. Now, the question around the market and what happens to equities as they begin to price in a slower growth or potentially recessionary environment, I don't think it's wildly out of touch to say that retesting the October and the June lows is in the cards if we see that deterioration in growth, and particularly if we see that deterioration in growth pass through into corporate profits, but we struggle to see material downside beyond that. So the bottom line is that it's going to be a volatile couple of months here as we get more clarity on exactly what any sort of economic downturn might look like. And again, we think that markets will begin to reflect that reality a bit more than they are today.
So Dave, that then leads to the question of how investors should be thinking about this just in terms of their positioning right now, because given the fact that tech was such an outperformer, so much of the gains really attributed to just over a handful of stocks, what does that mean then for some of the leadership maybe that's best positioned to withstand some of the volatility? So
from our vantage point, the key word for the second half and probably into 2024 as well is going to be optionality. We don't want to tether ourselves to anything that's too far out in the future. We don't want to make big bets on things that we can't, necessarily foresee with any sort of clarity. We like the idea of owning equities and bonds that return cash to us relatively quickly so that we can then take that cash and turn around and do something with it when the opportunity arises. I will say we came into the year with a view that tech was going to be a good place to be. That enthusiasm's faded because the Nasdaq's up 30% so far year to date. But if we were to see a pullback in those names, that would definitely be a place that we'd be looking to step in, because I do believe that these are not your father's tech stocks, right? They're more defensive than what we saw in the late 90s and the early 2000s. So leaning a little bit more into value today, shorter duration on the fixed income side, leaning more into growth and longer duration assets as we get more clarity and when those opportunities present themselves.
David, you could certainly argue that there's a little more of a value play, especially in the big tech names, but there has just been this incredible run-up that we have seen, all fueled by this excitement around artificial intelligence. I'm just curious how you view that. Is it sort of a mini bubble? Is it investors sort of grasping onto any optimism in the concern and in the broad context of the headwinds that are coming through on the macro side?
So I think longer term, artificial intelligence, it's going to change the way we all work and live. The question is when? Is it going to change the way that we work and live? And I do think that investors may be a bit over their skis in the current environment, expecting these productivity gains to materialize effectively overnight, whereas we see the runway here as being a bit longer. And so it definitely will help boost growth longer term. But I think that investors, I wouldn't call it a mini bubble. I'd say what we're dealing with today is more FOMO, right? It's the fear of missing out. It's the idea that these are the companies that will lead us to the other side of the AI revolution. First of all, that's a really big bet to make. I'm sure some of them will be around, but perhaps not all of them, and at least not play the role that investors seem to be pricing in. And so I think investors need to be nimble and they need to be flexible. They don't need to bet the farm on a handful of names, thinking that that's going to be what gets us to a more productive AI-driven world. So long term, we view this as having significant potential. Short term, I'm viewing it with a bit of skepticism.